Morning everyone, this is Rajendran here joining from Bangalore, and welcome everyone to zila 2.0 webinar on market profile nuances and references. Just give me a quick confirmation before getting into the session. I guess we can kickstart, right? So before getting in the session, just let's have a bit of warm up, so that we can understand just a revision of what we done yesterday, so that everyone will be on the same page. It's kind of a puzzle. It's kind of an. I'm going to draw over here, and I want to ask the question, and you people are going to answer back, right? So let's say this is yesterday's high. This is yesterday's high, and the market is opening with a gap down. So what kind of confidence it is?
It's a high confidence.
High confidence, buying or selling?
Selling.
High confidence selling, right? That's great. And let's say it's the same previous day high. This is the previous day high and previous day low, and market is. So let's say I draw a dotted line over here. And let's say market opens gap down, and price comes exactly to the level, and selling is happening there. And selling is happening over there. So who is dominating over here? Who takes trading decisions over here? Exactly at the previous day's low.
It's weak traders, right? Short term and weak.
It's mostly trading money, and mostly intraday traders behave like that. And multiple, if you are seeing that multiple times, it is respecting over there. It's more and more the weaker traders are going to do that. Most likely the stops are going to build above this reference level, right? And again, let's say, let me open a new setup. So let's say I am having a prominent point of control. We call that as a PPOC. If I'm seeing a prominent point of control, what is a prominent point of control, first of all? Can anybody explain? And
it's a 10 more than 10
TPOs.
VPOs.
Yeah, more than 10 TPOs. If it is more than 10 TPOs, we call it as a prominent point of control. If it is more than 12 or 13 TPOs, if you're going to see, it's more, we call it as a very prominent point of control.
It's an area where most of the trade facilitation happens during that day.
Yes, and who is controlling that? If you are seeing a prominent point of control, who is dominating in those regions? Is it an intraday trader or a short-term trader or long-term trader? Who is controlling those zones? If you are seeing a prominent point of control.
Intraday traders.
No, it is not intraday traders. It is mostly short-term traders. When you're seeing a prominent point of control, it is mostly controlled by short-term traders. Short-term traders are the one who holds between somewhere between 3 to 10 to 15 trading days. There's no actual definition of short-term traders, but who is holding more than a day, and typically who will trade between the zones, right? So mostly anywhere between 3 to 10, 12, 15 trading days will be an ideal guess for a short-term trading community. So today they'll be long. So it's like 10,700 and 11,000 game. So right now it's the same game which is going on in the markets, right? So I already given an example over there. So 11,000, and so they play in the zones. So when they go to the reaches to the extreme, they don't give a commitment to that. They give commitment only for 3 to 10 trading days, and then they flip. So again they will flip. Again they will flip. So they don't give a solid commitment over there. Unlike intermediate investors or long-term investors, they don't give solid commitment to that, right? So okay, let's have one more quiz over here. Let's say I'm having an value area. This is developing value area, and markets are doing some activity over here, and all in a sudden markets just spikes down during the middle of the day. And what we call this, and who is controlling there? This is value area. This is today's value area. Value area represents 70% of the trading activity, right? So 70% of the trading activity, and all in a sudden price is going down below value area,
If it is a spike, it is intraday players.
The
Alright.
momentum traders.
Emotional traders.
It's mostly momentum traders and emotional traders. We call it as, and we can combinedly call it as, and they are emotional momentum traders. So they might be panicking. They're just simply following the price. They don't look into the value area which is developing. So they don't give importance to the value area. They're just simply following the price. And most likely we call that as what? Short in the hole. So we call that as a short in the hole, means most likely they are going to get trapped. Right. So most likely what price does is that if it is a news-based sell-off, later on it could stop, and price usually mean towards back. If you have a sufficient time, another 1 or 2 hours, 2.5 hours are left in the markets, then mostly it end up in retracing back. When I say mostly, I am meaning 80% of the time. So 80% of the time, so it's gonna create an it's gonna roll back into the value area. They're gonna end up trapped, right? So yeah, it could come as a spike, but anyways, we'll talk about spike on the later part of the session. But let's say again, I'm having an point of control, and all in a sudden, price was in the first half of the session, the price was doing nothing, mostly balancing, and lately there was a spike coming in. So a late 45-minute spike. Let's say last 45 minutes, there was a spike coming in. Who is responsible for this auction? Who is responsible for this last 45-minute spike?
The institutional investors.
No.
Short-term traders.
No. I mean, they have a very specific classification here. Kind of, we call them as an late momentum traders. So we call this a MOMO traders or late momentum traders. They are part of the laggard community. If you understand, yesterday we talked about innovators. We talked about the early adapters, early majority, and late majority, and the laggards. The laggards are the one who comes and catches the trend. So they'll be very late to the party. Until then, let's say most of the major swings.
No, sir.
Come again?
Oh, sorry.
Yeah. Okay. So let's say a trend is getting developed, right? So trend is getting developed, and tomorrow there is some news announcement, some GDP announcement is going to come. What typically the market does is that it does balances for the day, and lately you might maybe some the market, some negative news might be started developing from there on. But despite all the negative news getting developed in the global markets, what market does is that it just does a sharp spike. So it creates a lot of anticipation that this news is going to be good, that the GDP announcement is going to be big. So it does a spike, and most of the time laggards are going to come and pile up over there because they are the one who believes those news, which comes at the climax. And typically what happens in the live market scenario is that either it straight away takes the very next day you can find a gap down and market started running up, or one of the day it balances, one of the day it balances, and second day onwards it does the correction onwards. So where this kind of activity, where this kind of spiking activity is coming, it matters a lot, right? So over a period of time, I'm going to give you a classification. First of all, let's go through the basics, but then now later on we'll look into these kind of spikes in detail, like which one to believe, which one not to believe, and how you can make use of those spikes. Not every spikes are market tops, right? There are times spikes are the one which creates trend reversals. So which one to consider as a trend reversal, which one to consider as a market top, I'll give you a brief classification later on in the later part of the session. But as of now, it's one of the places where momentum traders pile on, right? So we call them as MOMO traders. Momentum. They chase the momentum, and most of the time they come and catches the market tops, or most likely it's very close to the market tops at times. But then not every time it's going to be, and at times you can see a continuation also. But if it is coming at a major market tops, major swing highs, you need to be really careful about it, right? Okay. I'm gonna ask a couple of questions here. We also talked about one of the signature trades yesterday. Let's say there is a prominent point of control, PPOC. I'll say like PP means PPOC. And one more day, we have a continuous prominent point of control. And one more day, prominent point of control. And one more day, we have a prominent point of control. So let's say when you are having a prominent point of control, multiple prominent point of control like this, what does it mean, and what could be the reaction to the markets? Let's say continuously every day you are seeing a prominent point of control. None of the prominent point of control are getting cleared. So these levels are getting extended. These levels are getting extended. The reference line, if you are drawing there, it's getting extended, right? So it's not touched by the market none of the days, and still all these are untouched reference level, which you used to carry forward. In such a case, what typically used to happen when you are having this kind of prominent point of control?
The market is waiting for something to crash
Yeah, why?
because of events or news.
No, why? What does this means? If the prominent point of control is not getting clear, what exactly it means?
Actually, prominent point of control usually get created by short-term guys.
Yes, exactly.
So there'll be a stop loss zone that will be formed over it.
No, it is not a stop loss zones. The only thing is that the short-term players are accumulating and accumulating and accumulating and accumulating. It is like the maybe let's say you are a store owner, and there is one new fancy product is coming in, right? And let's say it's an iPhone. iPhone 10 has been announced, and you thought like the sales should be going good, and you are piling the inventory as a so you think like it will be moving off from the shelf faster, but despite your expectations, it's not moving much. So it's still, but you piled up everything. You piled up a lot. You piled up you accumulated the inventory a lot on the anticipation that it should go up. But eventually, what happens is that there is not much of takers in your shop. In that case, what you'll do? Still a lot of inventory is piled up.
Liquidate the inventory.
Yeah, you will be giving some discount, and you will try to liquidate as much as possible so that you can move on to some other product, or probably you can do something else with. So you will be giving offers. If nothing is happening over there, so let's say think about from the traders' shoes. Like, so the short-term traders are piling up. Let's say 100 people are there in the room. Initially 25 people bought up here, another 25 people bought up here, another 25 people bought up here, another 25 people bought up over here. Now all the short-term players in the room are completely with full stomach. Like, everyone has been completely offloaded. Now, if nothing is going for them, what they'll do is that they are the very first one to liquidate, right? So because short-term traders' nature is something like that, they don't give solid commitment to their positions, right? So they generally give 3 to 4, 5 to 10, 15 trading days, but they flip their positions anytime. They flip their positions anytime. So when you're seeing this, they are fully loaded. All our short-term players, they piled up, and now if nothing is going for them, let's say when markets started moving down, what happens is that these are the first guys to liquidate. These are the first guys to liquidate, or these are the guys who already sitting in the profit. They might be started booking profits, and that will create an avalanche reaction. So these guys will try to liquidate, or these guys might try to book a profit over here. So it will create an avalanche reaction, and probably it clears all those reference levels. So these kinds of opportunity, it comes once in a year or once every 6 months. Maybe it might happen somewhere else. It might happen in HDFC Bank. It might happen in Reliance. So when these are happening, or it might be happening in any other trading instrument, the concept remains the same. It tends to liquidate the participants who are onboarded over here. It tend to liquidate in that scenario. At times it creates, we call that as an inventory adjustment. We call that as what? Inventory adjustment. So who are added to their positions, they are the first one to get out of the game, right? And that is precisely going to be it's an opportunity for the institutional investors to observe all those things and they'll be taking higher again, right? So it's because all these are short-term traders. All these are short-term traders. When they are liquidating, it creates a tremendous liquidity on the downside. So many people try to exit. That will be completely and institutions love all those setups. Like, so you can see this kind of happening in the markets. Okay, so again, couple of questions here. Let's say 1 hour range. This is first 1 hour range. We call that as initial balance. Who dominate the initial balance? First 1 hour range. Who dominates the initial balance?
Intraday players.
Intraday players.
Yes, exactly. Intraday players dominate the 1 hour range. And let's say one time framing is happening. Market is doing one time framing. What does a one time framing means? Yesterday we talked about one time framing, right? What does a one time framing means? This is one time framing and this is one time framing down. What does it exactly means?
Long time players or
No, I'm not talking about players. What does one time framing means?
Trend day.
No, one time framing means like it's a one form of confidence, market confidence, right? So where the previous low will not be broken by the current low, and it keeps on moving in a pattern, right? So even if you look into the Nifty daily charts, maybe I'll pull up the Nifty daily charts, and you might be seeing that patterns across any time, every time frame you can see it. That it shows the confidence of the players in that particular time frame, right? So one time framing is not a buy or sell, but it's one form of visualizing the time frame. Let's say I'm going to pull up 30-minute daily chart. Yeah. So there are phases where you can see that one time framing happening over here. Maybe I'll show you the phases here. Yeah, think about this phase. So one time framing, one time framing, one time framing, because the past lows are not taken up unless it broken over here. It broken by marginally broken, and then it came back into the reference. So one time framing is one form of market confidence on the sell side, right? So again, you can see one time framing at multiple places here, again here, again here. You can see that the previous bar lows are not broken, but whereas it got broken over here. And again, this is one time framing on the upper side where the lows are not getting broken over here. So that shows the confidence of the buyers on that side. So many people tend to trade against one time framing. Even in my past careers, I traded against one time framing. Most of the short-term traders play against one time framing. That is very vulnerable to trade against. When the markets are showing confidence, it's better to not to trade against one time framing. So again, what we have done is that we done a classification, which one time framing to fade and which one time framing not to fade based upon the market confidence, which I am going to talk in the afternoon session, right? And so one time framing is nothing but one form of market confidence. It's one form of market confidence. So if the one time framing, if you are seeing on the profile charts, it's a sign that the markets are exhibiting confidence over there. And again, one time framing on the downside, markets are showing confidence again. So it's basically not to trade against one time framing. There are days what happens right from the day start, the market will be moving in a unidirection right from the day start. You might see it happens very rarely. Hardly it breaks only once, and it keeps moving up and up and up. So those are the days where most of the time frames will be participating. It will be dominated by intraday players, short-term players, long-term players, intermediate players. Everyone will be aligned in the same direction, right? Okay, one final quiz, and then we'll get back into the session. Let's say This is yesterday's high, and this is previous day high and previous day low. Previous day high, and we are having a half back here. Yesterday's half back. I'll put it like HB, and the market opens here and got back into the reference. It went back. It comes and testing exactly, and it's moving up. So who is responsible at the half back? And what does a halfback means? What does a halfback means, and who is responsible for the halfback?
Again, it's short-term traders or intraday traders.
Yes, the short-term traders are intraday traders, but it is mostly done by intraday trading community because it could be pivot of some people might be following the high plus low divided by 2, or some people might be following that high plus low plus close divided by 3. So it mostly comes around that center point of the day, and people like to initiate a trade around pivot points. Nothing much. Okay, so let's quickly get back into the session. We have a lot to cover today. And okay, one more final thing I would like to talk about it. And with that, we can close it. So let's say this is my yesterday's prominent point of control. I'm talking about prominent point of control. PPOC. And at times price comes and touches the prominent point of control and it bounces back. So who dominates there? It doesn't happen frequently, but when you are seeing a prominent point of control, price and comes and touches prominent point of control and it exactly moves, either exactly or one tick below or one tick above, and then it moves exactly. Who is dominating there?
Swing traders.
Yeah, mostly intraday traders. Intraday traders, they usually tend to take a trade over there because most of the time, wherever you're finding a prominent point of control, the volume profile also will be a bit bigger. So what usually happens here is that many people try to use the volume profile charts. So they'll be using that as a support, and it bounces back. So who are responding at mechanical references, they are meant to be revisited back again there. So mostly intraday traders are trading money, watches those reference level. So if they are trying to, when the prominent point of control is testing and exactly bouncing back, it is also a weaker reference. So over a period of time, you need to classify which is a weaker reference. So if you're seeing that price is touching exactly and bouncing back at the weaker reference, one of the example I'm going to show over here. So if you look into this example, you can see that it's a prominent point of control, right? And you see the H period is coming and testing exactly that reference, and it bounces back. That means point of control got tested, but it's very mechanical. End of the day, price closed at the day's high, but the reference level I am going to carry forward, which is going to get, which has a very higher odds of revisit, right? So again, this has to be taken care in your mind. Most of the time, what happens is that when the price comes and touches intraday, it bounces back from the prominent point of control. It revisits back. If it is not revisiting back, then it's still an opportunity to fade towards an prominent point of control. Maybe the very next day, usually tends to clear. Probably we can say like we can value that as a T+1. T+1, it gets cleared. It usually comes intraday. It gets cleared intraday. If it is not getting cleared, it will be cleared on the very next day itself with a very higher odds. So it used to happen. It used to happen not much frequently, but at least once in a month, it comes and touches prominent point of control and it exactly bounces back. Mostly the traders who are involved over here are, it's trading money is involved over here, right? Okay, failed auction. Failed auction, again, it is an interesting pattern. It is not from the Jim Dalton's concept, but it is mostly from Ray Barras from tradingsuccess.com. So he's a fund manager, by the way, and he observed this pattern. The pattern is pretty simple. What he'll be looking into failed auction is that he'll be waiting for the IB to break by one of the letters. See that the IB is over here. IB is nothing but the A period and B period high and low. it got broken by only one letter. On that day, only one letter the letter J got broken, and once the J got broken, immediately it pulled back into this IB. So it pulled back into the IB high. So here is IB high. You see that only letter J got traded. A lot of elongation comes. Immediately it pulls back. None of the letter got traded above the IB high. Suddenly there is a reversal coming in, and market went to the other side. So it is something like this. If you are watching that, this is IB high and IB low. This is the first 1 hour range, and the price breaks at one of the period. Same 30 minutes, less than 30 minutes, price got back into the range, and price moved to the other side. Price moved to the other side. So then we call that as an FA. We call that as a failed auction high. Maybe I can show you one live example in Bank Nifty recently. One of the example. So here is the Bank Nifty charts, and I'm going to show you how the auction on 1st January happened. Okay. We'll compress it. So here is IB high and IB low. This is A period. This is the A period letter, and this is B period letter. The A and B period high was considered as. So what happens is that one of the day it broken the letter B. You see that only one letter got broken, and none of the letters got down below the IB low. And all of a sudden it reverses the trade to the other side of the IB. Right? It completely reverses the trade towards the IB, and that is where you can see that reference level is marked as a failed auction. And we call that as an FA or a failed auction low, FA low or failed auction. I call that as an FA low. The context is that usually it tend to mean reverts back. Less than T plus 5, less than T plus 5, plus 5, with a greater odds. Right? So we have been trading failed auctions since for the last 3 to 4 years. What the success rate is closely 75% when it comes to index. Success rate is in Nifty or Bank Nifty, the win rate is closely 75%, and it gives a tremendous odds on trading. At times, when you are trading with Bank Nifty, it gives you 300 to 400 points opportunity. When it comes to Nifty, not every time the opportunity will be there, but at times it can go up to 100 and 150 points. Right? So failed auctions are, if you want to trade failed auction, you have to wait for the price to move to an extreme, such kind of an extreme. So one of the extreme which you are seeing here is, it's almost, this particular day, it's almost 450 points from the low to high, right? So almost 450 points, 450 points. When you're seeing these kinds of odds, and you know that within T plus 5 days, you have the odds of revisit. So those are the days you can, yeah.
Yeah, sorry to disturb you, sir. In this one, the failed auctions theory, like the green color candle, like the green color bar,
yeah,
we also call them as a big player, na, sir?
No, it's not a big player. It's the auction is not completed. That's what is happening here is that the price is breaking it actually, right? But then instead of a continuation, all in a sudden the auction is completely reversing to the other side. So what Ray Barra says is that it's an incomplete auction. So price eventually returned back to test that reference level to complete the auction. Right. So we are not talking about any big player or small player in the when comes to when comes to market profile. We will be talking about how the auction happens, how the auction behavior happens, how the traders behavior happens, why it has to revisit. So it's kind of an incomplete auction, because all in a sudden you are taking an U-turn, and that U-turn is happening really fast. That is where that auction is considered as an incomplete auction, and the price often revisit back within T plus 5 days. Within T plus 5 days, most of the times you'll be getting it in T+2 or T+3. Very rarely it goes to T+5, and you get a revisit over there. But we practice this only in Nifty, Bank Nifty. We don't practice this in stocks. Stocks, the win rate could be anywhere between 50 percentage, I would say that. So we don't seriously take failed auction in stocks. So if you are trading failed auction in stocks, aware that the win rate is only 50 percentage. It's 50-50. So, but when it comes to indices, the win rate is quite higher. And apart from that, we have a couple of concepts which will tell you whether to fade this failed auction or not to fade this failed auction. Right? There is one more failed auction there which is not cleared. So that is on the downside. This failed auction we never attempted at all. There is one more failed auction over here. But if you would have followed the process, then the process would never allow you to attempt towards the failed auction at all. There is one more failed auction which it similarly it happened over there, right? It happens over there. Whenever such failed auctions are coming in, and you're getting a lot of single prints over here, and markets are not allowing you to close below the single print zones. So these two single print zones act like a support. If markets are not able to penetrate towards that, then it may not clear at all. So what I'm trying to say is that failed auction is alone. You're seeing failed auction. We just like that. We don't trade failed auctions, right? We'll be looking into the other surrounding factors as well. Maybe over a period of time, we'll explain what are the other surrounding factors, how you should watch, right? Now, similarly, there are other failed auctions. When failed auction comes in Bank Nifty last month, it got cleared. There is one more failed auction sell came. So again, there is one more failed auction sell. It's a similar setup. So you see that the yellow color bar, it broken only once. It moved to the other side of the IB. So there is one more. It broke on the IB low, and it went back to the IB high, and it closed over there. And that reference level got cleared the very next day itself. With T+1, it got cleared. And in a month, you'll be usually you'll be getting 1 or 2 failed auctions in a month. Very rarely it goes to 3 or 4. But 1 or 2 failed auctions, either in Nifty or Bank Nifty, somewhere it will be happening either here and there.
Here, one question is like whether it is forming a rally high also.
Yeah, that's a very good question. When you're seeing a rally high, we'll be measuring rally high only on a stretched mark profile. So if the profile is very stretched, then only we'll consider it. This we don't consider as a rally high or pullback low because it's a bulged profile. On a bulged profile, there is no rally high, there is no pullback lows. So if it is an elongated profile where the rotations are very thin, let's say a 6 point, the TPO, the point of control, if you measure the point of control will be anywhere between 6 to 8 or something less than that. If you're finding 9, 10 and all, it comes into a prominent point of control. Mostly it is controlled by the short-term players, whereas a rally high or a pullback low are stretched elongated profile. Mostly institutions might be playing in those zones. If you look into the order flow, the flow on that day could be really good. So rally highs, pullback lows are most likely to be controlled by institutions. So that shows the presence of some stronger hands. Whereas if you are seeing the bulge profile, it's mostly a short-term trading activity. Institutions might be there or might not be there, but they are not dominating. Who is dominating here is the short-term traders who are dominating that throughout the day. They are dominating in that zones.
Thank you.
Yeah. Same pullback low also. We don't consider these days as a pullback low or a rally high because you may ask like market went up and it went down again. You can see that pattern here. So what does that mean? Is this an pullback low? No, it's not a pullback low at all because you see that it's a bulged profile. It is a bulged profile. More activity was happening over here. So we don't consider that as a pullback low or it's not. So in a pullback low mode, you'll be seeing something like it will be a sharp rally and mid of the day inventory correction and sharp rally again. So very, very less rotations will be happening over there, right? So whenever the price returns back to the failed auction levels, that levels precisely it comes and revisits back. And you know why it has to revisit back? Because it's a poor auction. Market come down to repair it back. Then we say like the poor auction zone, the failed auction zone got repaired. The auction is complete now.
Rajendra, one question.
Yeah.
Can you go back to the previous slide?
Yes.
This one, so 929. After it repaired, did it continue going up or did it,
It continued going up because this particular day was an RBI policy announcement day, and that day RBI slashed the interest rate by 50 basis points. So you notice the D period. The D period alone, it's almost 100 plus points, and that particular day it closed around some 200 points or 150 point plus from the lows. It continued. It continued, and it's kind of an open price open gap down. That day was an even day, and market shooted up. Market came up with the news, and that pushed the market to the other side completely, and that cleared a failed auction as well.
So do we see a pattern where if the failed auction is on the buy side, the subsequent after the correction, it continues on the upper side? And similarly for a failed auction, the sell side, once it gets corrected, the trend continues on the lower side. Is there a pattern like that that we see in the failed auction, on which side it is depending on?
No. We're not after that. We don't look into the continuation, or we don't look into the thing. Now we'll be checking what if once the failed auction is cleared. We don't even look into whether it will continue or not. We don't look into that aspect.
Okay. So only the failed auction, the opportunity.
Yes, exactly.
Okay.
Yeah. Again, excess high, excess lows. Excess high and excess low, it happens across all the time frame. It happens in market profile also. In terms of market profile, we'll consider that as nothing but a tail. But when it comes to daily chart or a weekly chart, you can see that excess low or excess high happening in the form of it's a rapid counter action move. So if you're looking from an intraday perspective, you'll be seeing like this market opens casually, it drops a lot, and it comes back, and it creates a strong kind of an hammer kind of pattern. You might see that kind of a strong hammer kind of pattern. If it is coming at a market lows, if the market is coming on a downtrend and you are seeing an sharp excess on the downside, you will be seeing that. If you're watching a bar chart, you'll be watching the bar chart will be having a strong tail, that we call that as an excess low. Excess is it marks the end of one auction and the beginning of a newer auction, and it occurs all the time frame. If it is coming at a major swing low, definitely we'll give importance to that. Right. So in the past, in Nifty, it happened a couple of times. So maybe I give an example here. You can see a couple of places where the excess came. The excess which is coming at a major swing high, it has a short-term impact in the market. It all of a sudden it turns, and it has a very short-term impact. At times it could be a long-term excess also. Long-term excess also. Maybe I can show you one of the excess which came now. Probably. Let me open trading view charts. Excess is one form of market top or one form of market bottom. Daily time frame. It needs to have a strong tail first of all. So recently there are no excess patterns. There's one excess pattern over here on this particular day. This particular day there was one excess pattern.
Just before that, isn't it an excess pattern, Rajendra?
It is, yeah. Before that there is one more excess pattern. You can see here. This is it combined with one of the event day, I believe. What event it is Karnataka election. This is Karnataka election date. What happens is that Karnataka election, first 1 hour it was a rally, and lately it given up all the rally, and it forms an excess. And the excess brings short-term downtrends, right? So at times it could be a major market tops also. And so this is Karnataka elections. We got an excess, and one more excess we got on.
Rajendran.
Yeah.
See, the excess is the hammer in a day time frame or 1 hour time frame, or how
It can happen in any time frame. So maybe I can show you once I'm done with this. You see, this is an excess here. You see that
you are seeing daily time frame, right?
right now we are talking about daily time frame, but it can happen on any time frame. Even it can happen in 1 minute chart. It can happen in a hourly chart or even a quarterly chart. Also, it can happen.
Okay, the one you marked is a hammer or?
So what I am seeing is that after a downtrend, you have it leaves a sharp tail on the downtrend.
Okay. Mm-hmm.
So this is not a sharp tail. So you see that the tail is pretty small over here. We don't consider that as an excess. Whereas here, most of the time it will be combined with some sort of an events. So this is kind of an excess here. This is a small excess over there. Oh, sorry. And this is one more excess. This happens on budget day, union budget day, where the market was doing like this. It was doing like this, and all in a sudden, mid of the day, it crashed. Again, it went up. It does a deep crash. Almost that crash was 300 points, and finally recovered back most of the crash. And finally, it closes here. So that it leaves a strong tail on that day, and it's also, as I said, it's mostly combined with some sort of an events. Right, so this is with Union Budget Day 2016. That forms a bottom, and one more mother of all the excess I'm going to show you. It's happened in 2008. I'm not sure how many people got traded by that time. So this is somewhere around 2000. This is 2008. You see this? Maybe the candle looks pretty small, but that candle is a 10% crash. Intraday, there was a crash of 10% followed by a recovery. Any idea? Anyone able to understand why this crash happened? It's a 2008 crash. It's a 10% crash followed by a recovery. Complete 10% got recovered by end of the day, and that happened on Diwali. It happened on Diwali, and there was a complete crash. It happened due to Lehman crisis. So one of the day Lehman crisis, the market crashed. The very next day, there was a continuation of the crash. The entire world is collapsing. The US markets are again down by another 5% or so. And Japanese market, you name any market, it is crashing. And Indian markets also, it opened casually, but then it dropped almost 10%. And then it's that day is 2,500. The closing was somewhere around 2,500. The day's low was 2250. Right? So it's a 250 point crash. That means it's a 10% crash followed by a complete 10% recovery. Right. So now that's the mother of all the excess. And till to date, that low is not breached yet. Right. Now I'm going to show you one more interesting thing. It's on the quarterly time frame. So here is the quarterly time frame, and the quarterly time frame we had an excess here. So you can see that we are having an excess over here, so which is cautioned setup. So long time frame, if it has to fade out, a lot of price has to do a lot of activity over here, right? So, but we are not we're not investors. If you're investors, you should be cautious about this setup, right? So this is not a warning sign for your longs in your 5-minute time frame or a 10-minute time frame. But if you are an investor, you should be really cautious about this setup. You can see that it's a nice clean excess. It's a classical excess, I would say that a typical classical excess will look like this. If you are looking into the profile pattern, it will be looking like this, where the market trends, and on the quarterly time frame you are seeing an excess. It's a warning sign for the investors here. But if you are a trader or if you are a short-term trader, you should be learning to trade both the sides. So we don't care. Do I care? I don't care.
Rajan, provided that doesn't the high is not taken out.
Yeah, that high is not taken out. Yes.
Yeah, until it is taken out, it is not taken out. It is an excess.
Yes, that's what I'm saying. I don't care. I don't care because I'm not an investor. If I'm an investor, definitely I do care. Right. So depends upon what time frame you are, what time frame you're watching. You have to act accordingly. But so if I'm a short-term trader. So today, if there is a long opportunity, I will go long. Tomorrow, if there is a short opportunity, I'll go short. But this is one information we will watch out, but it will not impact my bias. But yes, this is one thing. If you are an investor, you need to be really serious about this. Nothing else. So, what chart you are watching, which is belong to what time frame? So, do I have to value this, or should I have to take it into account? You have to be. But if it is happening on a daily time frame, definitely yes, I might be adding as one of my trading reference. I'll definitely consider that as a stronger zone to it. But as of now, I don't. The thing is that I don't. And this is one of the day we got an excess over here. The excess, and there was a rally which was coming in, right? So that's how it is. And this is from the price perspective, which is nothing but a tails. So if you're seeing a strong tails, then we can call it as a nice clean excess. Excess indicates end of one auction and beginning of another auction, right? So the tails, if you're seeing a strong tail, then it is called as an excess. So nothing much to talk about it. It means it's a good low. It's been a good low. So there is no thing like that low will be tested or not tested. We don't have anything like that. It's a good low. That's it. So it's not a poor low. If it's a poor low, then price has the higher odds of coming and revisiting. If it's an excess, if you are seeing on the profile, it's nothing. Not necessarily it has to come and revisit. It's not a support or a resistance. Nothing. But if it is happening on the daily time frame or a weekly time frame, it is end of one auction and the beginning of a new auction. Excess on the tail is also what? Nothing much. If you're able to see an excess on the chart, it's nothing but that particular day the auction ends here. It's a very good auction and the new auction started, right? So all these you can do only as a start after market studies. Live markets, you cannot spot an excess on the profile. Be clear about it, right? So excess are nothing but tails. If it is a good tail, we call it as a excess. But you can spot an excess on the daily chart once the day completes. Whether the day can be an excess or not, only you can guess only the day closes. Until the day closes, you cannot be very sure that this day could transform into an excess. We tried it, it doesn't work that way, right? Is there a way where we can anticipate excess? You cannot anticipate an excess. You can only realize once the day is about to close. Once the day is about to close, you know that this is some sort of an excess, and then you can take a trade decisions over there. But there are times on the daily time frame it will be happening like this, like in between the time zones you'll be getting an excess here. So we don't value those kinds of excess. The excess should be coming at a major swing high. Then then we value it, we give importance to it. Our excess should come at a swing lows, then we value it. Something like if it is coming in a congested band, if it is coming in one of the congested band in between the profile, we don't consider this as an excess, right? So we value only if it's coming at a major swing high or a major swing low on the daily time frame or a weekly time frame or the quarterly time frame. The one which I shown on the quarterly time frame here, which is coming at a major swing high, right? It's not coming intermediate. It's coming at a major swing high. It's coming at one of the all-time high, and there was that particular day it was an excess. Some other places we got an excess here. This is one of the places where we got an excess, and then you know the rest of the story. Maybe this has to be given some investors has to be cautious. That's what I can tell you. Okay, so one time framing.
Rajendran.
What is that?
I was looking at 9,000 levels with the excess being formed.
I don't have any opinion on that. It's better not to put any opinion. Just go with what the market is saying, right? So I already had a lot of opinions. Every time I had such kind of opinions, and I will be right in my own time. I'll be right, but the question is, am I right in? Am I right now? That is the question. Right? So, if you're a short-term trader, you don't need to bother about whether the market is going to go 9,000 or 8,000 or 7,000. Right? So all you need to do is that, is this market going to go tomorrow 11,000 around 11,000 or what, or the 10,800 plus? Is it going to sustain? How the confidence is going to be? Should I have to reverse from 11,000 or should I have to continue at 11,000? That is the only focus as a short-term trader. If you're a medium time frame trader, you have to be a little bit. You can have a little bit leverage on the trend. So is this trend which is going to reverse on Monday with the gap up which is going to come on Monday? Is this going to be a strong rally? Am I going to get some 200, 300 points or not? Or it's going to get respected at 11,000 and again I have to take an U-turn? Are there any significant signs that markets are going potential reversal point when it is reaching 11,000? So that kind of analysis is what you have to do, rather than saying that market there is an Rajendran had shown a quarterly excess. So definitely market will come down to 9,000 or 8,000, right? So that, yes, that is investors' nightmare. Definitely not as a short-term trader. If we are going to play that one game, we are going to lose the intermediate 1,000 games, right? And I prefer not to do that. Okay, now coming back. Yes, you can. If you are, let's say, if you want to value the quarterly time frame, you can still fade all the possible downside moves, right? So probably you can, every time you are seeing a short opportunity, you go and make use of it. And every time you see a long opportunity, you allocate less. Every time you see a short opportunity, you allocate more. Maybe that's how you can position yourself in the markets, right? But still, you'll be trading both the longs and shorts in the markets. Okay, so one time framing is applied to all time frame. It happens on monthly, it happens on weekly, it happens on the daily time frame. So I'm going to take a little bit of time on the one time framing because it's very crucial. The one time framing which is happening, it happens on the monthly charts, it happens on the weekly charts, it happens on the daily charts, it happens on the quarterly charts as well. And it's a sign of a confidence, nothing but it's a sign of a confidence. Let's say if this is quarterly time frame, right? So you see that this quarterly time frame, the one time framing is happening over here. The lows are not getting broken. You see that it's going up and up and up and up. So it got broken only last quarter. It got broken. Otherwise, right from 2016 onwards, the one time framing on the quarterly time frame charts, it never got broken, right? So you can see that again the quarterly time frame here. It never broken, and then it started one time framing downside. So one time framing downside is happening over here. So these are the signs of a confidence from the long-term players. If the long-term players are so confident, right? So you might seeing one time framing happening on the quarterly time frame. So see that those are the times, you know, that they are confident. Their confidence is not shaken anywhere here. And this is confidence from the sellers. You see that sellers one time framing confidence. Again, this is buyers one time framing confidence, one time framing up, 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 and one time framing up, and one time framing. Similarly, one time framing down, down, and down, and down and down and down. It's very clearly visible on the quarterly time frame. The long-term players' confidence you can be able to evaluate from the quarterly time frame, and also you can also evaluate from maybe the investors might be watching the quarterly time frame. Then maybe the big institutions, for them quarterly time frame might be a biggest key for them, because they mostly look into forward looking. So every time the market, this price is coming down very close to the quarterly time frame, they might thinking of accumulation, right? So that's what they had done so far. Every time the price is nearing, there is an event, because of that market is crashing. Let's say this is one of my quarterly lows, and let's say market is going up, and one of the days I'm getting an event, something like a demonetization, market is breaking, but still that it haven't broken the quarterly low, and they will come and accumulate in this band. So they use us, and they come and they might be watching the quarterly band. The institutions might be watching the quarterly band, so they allow to accumulate when there is someone is ready to sell, when the entire negative news is there. They want to come and give supports in those zones, so they allow to accumulate in those zones. So where is the demonetization happened? Demonetization happened somewhere during here, maybe in this quarter, I think. Okay, and monthly, again, one-time framing happens. You can see a lot of one-time framing coming in this band. The entire 2017 is all about one-time framing. So here, it's again shows the confidence of the investors on the monthly scale, right? So the one-time framing was continuing for more than 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 months. The one-time framing was continuing, which never happened in history of Nifty futures, right? So Nifty futures. So one-time framing, if it is happening, it's many people think like the market is getting overbought or oversold, and they trade against the market. But despite that, at times market will be continuing the one-time framing. It can happen on the daily chart as well. So if it is happening on the monthly scale, then or the quarterly scale, long time frame players are responsible. If it is happening on the weekly scale, if you are seeing one-time framing happening, then intermediate players are responsible. You see that the one-time framing sell-off is happening over here. It continuously breaking the lower lows, and finally the one-time framing come to an end over here, right? So that shows the confidence of the intermediate sellers. So some intermediate sellers, maybe some institutions might be responsible for this auction. So they might be offloaded over here. That's a long-term view you will be able to get from there. That shows the confidence of those players at that time, right? So, and daily, it's mostly if you are seeing one-time framing on the daily, it could be mostly driven by the short-term trading community. And if you are seeing it on the profile, that's a sign of an confidence from the players for that day. It doesn't matter which player they are, but they are not intraday players if the market is showing high confidence, right? So let's say if the markets are holding high confidence, let's say this is previous day high, and okay, I'm sorry, this is previous day high and previous day low, and market opens gap up. Let's say market opens gap up, and then market was doing something, and late of the day, market is showing confidence, right? So when the market is already showing high confidence, and you are seeing one-time framing, I guess it's a sign of an high confidence. Definitely, it is not controlled by the intraday player, right? Some other higher time frame is involved. Maybe they could be short-term player, they could be long-term player, they could be intraday player. Definitely, they are not intraday players, right? But let's say the market opens inside the range. And it broken the previous day low, and instead of that, it is coming back. If it is coming back into the range, and it is one-time framing. Here. Again, it's a sign of a confidence, right? It is also a sign that market broken the low, right? So if it is a good selling, what happened? If it is a good selling, price has to go down, right? But that's how good confidence will be, and point of control will be building below this reference. But despite that, market is reversing. Market is completely reversing back, and the one time framing is happening. That is a sign that the sellers are now no more in control. The buyers are in control, and they are one time framing. That is a sign that it's going to continue. It's going to continue. Again, some other time frame are doing responsive buying over there. They are mostly doing responsive buying activity. It's a sign of a continuation, right? Whereas here also some other time frame apart from intraday players are involved on the buying side. So you should not fade. You should not fade this one time framing also. So now you can ask a question: which one time frame I should fade? So one of the one time framing you should be fading is like, let's say you are having open a new one, and let's say this is previous day high and this is previous day low, previous day high and previous day low, and okay. So let's say market is opening with a high confidence. Market is opening with a high confidence, right? It went up initially, but lately one time framing is happening against. This is one time framing on the sell side. One time framing on the sell side. Market is showing high confidence. Market is showing high confidence initially. High confidence buying was there, right? Point of control was building higher. Everything was building higher. Now this one time framing is happening against the direction, but it's falling not much, but it is slowly falling. You can find this mostly mid of the day. You can find this. They are mostly intraday sellers. They are mostly intraday sellers who are most likely to get trapped. What market does is that lately market moves against those one time. You can see the pattern from the one time framing. It will be very thin and congested. Or let's say this is my previous day high and low. On the buy side, it will be happening as the market opens gap up, or market opens here and all of a sudden started doing activity on the side. You'll be seeing point of control building over here, and market will be moving higher. But lately, middle of the day, you'll be seeing that one-time framing pattern coming into it. So these are mostly intraday sellers. They are mostly intraday sellers. Minimum, you need at least four bars to confirm it. You need 4 bars to confirm it. What the resulting activity is like, price goes and test the day high. I'm going to show you one of the example here in Nifty futures. Which
Rajendran, 4 bars in what duration?
30-minute time frame.
30 minutes. Okay.
Yeah, I'm talking about intraday perspective.
Yeah, 30 minutes.
Yeah. So I'm talking about which one time frame to fade and which one time frame not to fade. Right. So to summarize, here. So all these information are available in the Slack. I posted all these information yesterday. Right. So maybe I'll continue with the same. So which one time frame to fade, and which one time frame not to fade. Okay. If markets are showing high confidence. So in the afternoon session, we will be dealing with which is high confidence, which is not a high confidence, and one time framing happens in the same direction, then go with the trade. Don't do mean reversion trading activity. Well, because markets itself showing one time high confidence on the buy side and one time framing also happening on the buy side. It is a sign of a continuation. It's ensuring that markets are still showing high confidence. So don't try to fade unless the one time frame ends, right? So go with the trade. But if the markets are showing high confidence and one time framing is happening in reverse direction, then trade against one time framing. So one of the example I'm going to show you in Nifty, which happens last month. It happens on this 18th December, I believe. Not 18th December, but exactly this. Yeah. So you'll see this pattern. See this pattern. Initially, this was my previous day high. So here is my previous day high. It got broken, right? So it got broken, and point of control initially started building over here. Lately, it started migrated over here, right? So point of control was higher for that day, and it was high confidence buying because point of control started building above the previous day high, right? One of the day, what is happening is that it's one time coming down and down and down and down, but then it completely reverted back. It completely went testing on the higher side. So the same setup was there in Bank Nifty on that day as well, 12th of December. Not much. It's not one time framing much, but the pattern was very clear in Nifty. And so you should not fade that one time framing. These kinds of setups happens once or twice in a month. If the markets are showing low confidence, I mean, we can say like bad confidence. Maybe as of now, I'll use the term bad confidence, but I don't use in real terminology, we don't use bad confidence. We use something like a low buyer confidence or low seller confidence. It's something like the seller confidence is poor or the buyer confidence is poor. Then, and one time framing is happening. One time framing is happening against the bad confidence direction. Then you have to go with the direction of one time framing. So go with the direction of one time framing. For again, if the markets are not showing any confidence, neither the buyers are not confident or not the sellers are confident. Sellers showing any confidence. And one time framing is happening. Then again, go with the direction of confidence. So you should fade only if the markets are showing high confidence and one time framing is happening against high confidence, then only you should fade the markets. Otherwise, all the cases it is go in the direction of the high confidence, go with the direction of one time framing, go with the direction of one time framing. So these are the 4 classification. When to trade, always go with the one time framing. Only fade if it is high confidence is happening. Let's say high confidence buying is happening. And you are seeing middle of the day, you are seeing one time framing. Then you go for expect a day high to get tested. Right. Similarly, on the downside, if the high selling confidence is there and middle of the day you are seeing this pattern, that one time framing usually will be taking around anywhere between 12:30 to 1:30. Anywhere between 12:30 to 2 o'clock. 2 o'clock we monitor for this pattern, and if the confidence remains high on the sell side, then only we attempt to fade the markets. Otherwise, we don't. I'm going to give you an example for this. When the markets are not showing any confidence and one time framing is happening, how the direction goes. This is also an interesting setup because it gives, again, most of the time it gives tremendous opportunities. Look into this example here. This is 18th December. 18th December. Initially, what was happening here is, initially, price opens inside the range. Price was doing something, right? Nothing much was happening over there. And lately, you can find middle of the day around 1 o'clock, you find this setup happening 1, 2, and 3, and 4. The one time framing started developing, right? So if you look closely here, let me zoom up this chart. Watch out the yellow color bar, the yellow color bar low, and notice this bar low. These two bars are exactly having the same lows. That means still the one time framing is on, it is not broken. As long as if it has to break, it has to break at least by a tick. That is not broken. That means still the one time framing process is on. Even if it's having a matching lows, even if it's an inside bar, still it will be considered as a one time framing as long as the previous lows of the bars are not taken out. So minimum we need 4 bars to confirm that one time framing. So 4 bars are confirmed, then it is a clear sign that confidence is developing. So don't do a mean reversion there. Instead, go with the direction of the breakout. And so, which is very tough because many people see that by that time their RSI will be overbought or oversold in their own time frame. But you have to go in the direction of the breakout, right? In the direction of the one time frame, which is a relatively tough decision to make because most of the market would have been moved by that time some 100 points from the lows, and still it may not psychologically allow people to trade towards the one time frame.
Yeah. Where is the entry point there after fourth candle?
No entry point. Either you can take supports from the order flow, or you can also use that one time framing, one of the base as your reference level. So let's say the one time framing is happening like this, right? So, and then you can consider that either this or this as your reference point to go along. So mostly what happens is that most of the time market continues. So I'm going to spot out one more example. So what you can do is that go and study more examples, and then you figure out where to keep the stops. Right. So I'm going to show you one more examples how it happened. Recently it happened. It happened on the recent fall from 11,000 Nifty. It's Nifty from the recent 11,000 fall. Yeah, here. Think about this particular date. You're getting my point? You're seeing it? So price opens inside the range, right? Price opens inside the range. In fact, it broken the IB also. It broken the IB, and it made a C period. And you see that it's still when it broken the C period also, still the previous day high is not broken. Previous day high is not also broken. By the time the previous day low is also not broken. Price is still trading inside the previous day's range. Letter A, B, and C all are trading inside the day's range. And all in a sudden, the one time framing started developing. So if the price is trading inside the range and still nothing is going on, that is a sign that now you see that letter C, D, E, and F all are one time framing, and it is going down, right? So all in a sudden, markets are not showing confidence. All in a sudden, one time framing is appearing on the downside. So that is a sign that there is an somebody is taking an responsive activity, right? So that we can consider market activity into two types. One is initiative activity, another one is responsive activity. Initiative activity is like market going up, and from there more people are initiating the trades. Again, it's a kind of an initiative activity. A responsive activity is like market goes up and somebody is responding to the buying activity. So they are responding to the so they are called we call them as a responsive sellers or a mean reversion sellers. Initiative activity is more of a trend following, and responsive activity is more of a trend mean reversion activity. So you can see the confidence is getting developed over here. It's a sign of a good confidence. So you'll be able to spot this confidence over here that it is a mean reversion activity. It's getting developed. Initially, the market is showing no confidence. Initially, markets are showing no confidence. And lately, you are seeing one time framing against no confidence. If one time framing is happening against no confidence, it's a sign that you have to follow the path of the one time framing players. You have to join along with them. Don't fight them. You have to join along with them. Right? So That's a very early sign. Typically, you'll be able to get at least, you can onboard either here or even the F period broken, you'll be able to onboard either here or here. Even if not at F period, you have ample time to enter here at G period. Right? So where to decide a stop loss? Probably you need to figure out, you need to go and observe all these patterns, how the one time frame behaved, how I have to deal with those information. So you go and study back all the charts, you go and study Nifty, Bank Nifty, Reliance, Axis Bank, you keep digging all those charts, and probably you try to learn where to keep a stop loss rather than me telling me where to keep a stop loss. Right? So, okay, just give me a second. I have to key in. So all I can give you is a framework how to deal with this information, right? So let's say I'm going to post this in the Slack, make use of this. So all the 4 cases, only one cases we are going to fade. So this is only one case we're going to fade here. Rest everything, we are not going to fade at all. Okay, and these kinds of one-time framing happens at least 3 in a month or 4 in a month or 5 in a month. These kinds of setups usually it used to happen in Nifty or somewhere in Bank Nifty. If it is not happening in Nifty, it will happen in Bank Nifty. So if you're an index player, you have a greater control about the one-time framing, and you know which one to fade, which one not to fade. Okay, and I guess we can take a small break here and we can resume the session in another 5 minutes, 10 minutes probably. Right, so we can get back by 10:35. 10:35, we can get back.
11:35.
Yeah, sorry, 11:35. Yeah.
Hello, Rajendra.
Yes.
Yes. Yeah, this is Sampath.
Tell me something.
Can you briefly explain about the low confidence and high confidence after break? Right?
I'm going to explain in the afternoon session.
Sorry?
Afternoon session.
Okay, Rajendra.
We have one complete session on confidence.
Okay, Rajendra.
Yeah. Thank you.
All right.
Okay, let's continue with the session here. So we are discussing about one-time framing and which one-time frame to fade and which one-time frame not to fade. Now, we also quickly look into the other nuances. Let's look into, I think probably, let's get into some of the basic sessions. I'm going to stop here. We'll continue this on the signature trading session. So I'm going to stop here and I'm going to open some of the basics again of market profile, the open types and profile distribution types. So before getting into this, let's quickly look into what range extension is all about. So range extension is nothing like, I have an IB, the initial balance, first 1 hour high and low range. And if one of the side, the IB is got broken, right? So we call that as a range extension is happening there. So either IB happens, range extensions happen on the upper side. If it is price is breaking on the downside, then we'll say like the range extension is happening on the downside. This is nothing but a terminology, but it's good to know about the terminology. Why the range extension terminology came is like the IB is mostly dominated by the intraday players. They are the first 1 hour. They are the one to pile up in any kind of markets. The intraday players are the one to pile up in the markets, and when the IB is going to get broken, that shows that apart from intraday players, some other players are the one who is responsible for that breakout. So some other time frame is trying to take dominance. We call them as one OTF time frame traders. It means other time frame traders. OTFs are nothing but other time frame traders. Anything other than intraday players, we call it as OTF traders. It can be, the OTF traders can be short-term traders or intermediate investors or long-term investors. They are nothing but, they have the muscle power to move the market beyond the IB, right? So if the market is not breaking the IB at all, there are days what happens, market forms an IB and market moves inside the IB, right? So market moves inside the IB. That means that particular day only intraday players are in control. There is no much dominance from the other time frame traders. So neither the short-term players are not confident, neither the long-term players are not taking control in the markets, neither the intermediate players also not taking control in the markets. So most of the cases, the day traders, they don't cause any major move in the market. So if you're finding that range extension is happening, then it's a sign of that either the buyer OTF has been entered or seller OTF has been entered. So maybe I can show you a couple of examples here. So look into this example. The IB is got broken on the one side. The letter A and B defines the IB here, right? So it has been broken at the C period, and it is a directional range breakout. The directional range extension is happening. So we say that OTF buyers are in control in this market. I don't use these terminologies on a day-to-day basis, but it's a good to know concept. It's a good to know basic concepts of market profile, right? So that means it's a directional OTF is dominating on that particular day. I'm sorry. So there are days where the IB will be broken on both the sides. In that case, we'll say like both OTFs are present in the markets. Again, these are textbook styles, right? So where there is an IB here, the IB, the letter A and B period, high and low. Initially, it got broken on the upper side, and lately it got broken on the downside as well. So in a mature market like US markets, the IB usually gets broken on both the sides. So whereas there are spaces where the IB breaks out on one side and it keeps on continuing, whereas the mature markets like US markets, it's very rare that the one time IB breaks on one side and the market continues. Most of the time you'll be finding this pattern. If you are seeing in US markets, it breaks on one side and it breaks on downside. This kind of pattern also it occurs in Indian market as well. Sometimes 7 times in a row or 8 times in a row. It used to happen where the IB got broken on both the sides. So preferably don't trade the IB breakouts. IB breakouts are not profitable all the time, right? Many new traders, they do that because there is a simplicity involved in it. And IB breakout of IB is not a strategy at all. It works in only in selected phases, but it doesn't work in all the market conditions.
Hello, Rajinder.
Yeah.
Yeah, Sampath. Rajinder, you said emotional traders, we can trade the time frame. Emotional buyers or emotional sellers is coming in trade.
Yes.
Yeah, we can trade the time.
We can trade
that.
No, I'm sorry, your voice is getting clipped. Can you?
Yeah, emotional trading. Suppose emotional trading will happen.
Yes.
We can trade the time, like we follow with emotions by our emotion cells.
Yes, you can. So one of the thing is that let's say that's what I spotted an example. When to trade against an emotional sellers is what you need to understand. So this is previous day high. This is previous day high, and this is previous day low. Right? Let's say the market is building the point of control initially. It's a low market is moving in a low confidence, and all of a sudden the emotional sellers are showing up. So markets are doing something else. All of a sudden, mid of the day, the market is breaking the previous day low. By that time, if you look into the value area would be something like this. Price is plunging down below the value area. Price is all of a sudden it is moving way down below the value area. At the same time, it is breaking either previous day low or 2-day low has been broken. If they are serious sellers, what they will do? They will go down and they do some activity over here. If they are serious sellers, but if they are not serious sellers, they will eventually rotate it back. This is where you can look for a mean reversion towards the point of control. This is where you have to look for a point of control, right? So,
okay.
Yeah. questions? So the question here is when to trade against the emotional seller. I'm not saying that every time there is a sharp sell-off, price is going down below the value area, you have to go and sell. If the price is selling off, at what is the level you are going to monitor? Right? If there is a level which is monitoring there, already most of the point of control is already formed over here, and price snaps back to the reference level, then I will continue to fade those levels. So for example, let's say there are 2 trading days. We have 2 trading days. This is a 2-day low, and let's say the same setup is happening here. Let's say the same setup is happening here, where middle of the day price broken 2-day low. Price broken 2-day. In that case, I will use 2-day low as my reference. When the price is now coming back, then I will consider taking my trades towards the point of control. But if there are no such references, let's say markets are falling, and one of the day price is doing activity here. This is my previous day low. This is my previous day low, and this is my previous day high. Markets are already building a lot of activity down below point of control, right? And again, I'm seeing some emotional selling. In that case, I don't, if I don't have any reference line to monitor over here, I don't look for a mean reversion. I don't do this, right? So it will be an, it is again when to fade those emotional sellers, when not to fade those emotional sellers. Again, it is an art. We'll talk deeper about it as you, once we done all with all those basics, then we'll be talking only about classifications, right? Okay, here are the basic profile distribution types, right? So these are the basic distribution types. We call as an 7 to 8 distribution types are there. One is non-trend day, normal variation day, trend day, double distribution day. Very rarely it can get into a multi-distribution day, triple distribution day, or a 4 distribution day, and neutral day, profiles, P-shaped profile and a B-shaped profile. That's what we're going to talk about it. In a non-trend day, typically it usually happens one day before any major event, where the IB will not be broken on both the sides. The IB would have been formed, price will be rotating inside the IB. It will not be broken by, it will never get broken either on the upper side or on the downside. Even if it gets broken, it will be broken by a tick and it becomes a poor high or a poor low, right? So most of the time we call that as a non-trend day. On a non-trend day, nobody is in control. It will be a very dull, boring market. You can feel the dullness as a trader. Throughout the day, you come into the markets, you are looking for opportunity, you take a trade, you take a buy trade, or you take a sell trade. Nothing will be going neither in your favor or neither against your favor. Market will be mostly rotating against the price, and you get a big, lengthy, prominent point of control over there. So those are the days where only trading money will be fighting for that. There won't be any serious institutional money will not be there. There won't be any serious long-term buyers or sellers will be clearly missing from the markets. Throughout the day, the market will be moving in a dull, boring fashion. These kinds of days are very rare, and it usually happens one day before any event or one day before any major announcement is supposed to come. And there is a market expectation is there. Mostly the institutions will be on a hedging mode, so they don't show up unless the event is over. And they are very rare. Probably if you take 100% of the profile, less than 5% of the profile are related to non-trend days.
Rajendran, is it this non-trend, is it also used to build inventory in terms of the volume, or is it?
No, you can find the volume will be relatively low there, so you don't find much of a volume there.
Okay.
Right, so and no IB breakout. It will be a balanced profile, very tight trading range. Means only day time frame traders are there. Nobody gets anything out of it. Neither the buyers or neither the sellers. Nobody gets any solid movements from the market. Nobody gets any benefit out of it. Who's that? Normal day. Again, normal day are quite common when it comes to profile. What I'm going to do is that I'm going to mute everyone.
Sir?
Yeah. So normal day, when it comes to normal days are quite common. You can find 65% of the time you're gonna see normal days.
Sir, a small doubt, sir.
Yeah.
In the previous slide, in the non-trend day, how to guess at the beginning of it time, sir?
See,
beginning of the initial period.
You cannot predict any of these days. You cannot predict any of them.
Okay.
They are just day types. They either none of them are bullish or bearish. But some of the reference level we can able to plot from days like double distribution or a triple distribution, or some of the days like P-shaped profile or a V-shaped profile. It has some meaning to it, right? So it doesn't. None of the days doesn't mean it is bullish or bearish. All you can extract is some of the key reference level. You'll be able to extract from some of the days like a double distribution or a triple distribution days, or a P-shape or a V-shape profile. So don't try to predict which day could be, whether the day will be trend day or not. Only beginners do that. Whether the day will be a normal day or a normal variation day, again, beginners do that. If you want to be one step professional, don't try to predict. These are just only the profile distribution types. And it says what kind of participation is happening over there, who is competing over there. On a non-trend day, nobody is in control. It's a dull, boring day. Mostly serious money is missing over there. Long-term players are not in control. Who is in control is only intraday players, and a short-term community is fighting each other. No major volume happens over there, means no active participation, and that is why it ends up in a poor volume, right? So, and you can see a prominent point of control most of the time. That means short-term activity and intraday activity happened on that particular day. Nothing much. There is no serious money.
Okay, sir.
And again, normal day are it happens 65% of the time. If you take most of the profile, 65% of the profile market will be trading in a balanced structure. Most of the normal days are kind of a normal structure. It creates an classical bell curve shape where more activity happens at the center. Participation will be good, but nobody is in control in this kind of markets. It's probably the day could be ending in terms of Nifty. The day could be ending up with 30 points higher or 40 points higher end of the day, but you'll be forming an clear cut bell curve distribution shape, and the IB will be broken only once on the either on the upside or on the downside. Or the IB, the initial balance range will be very bigger. In terms of Nifty, if you take the range itself around approximately 40 to 60 points or even 80 points, that kind of bigger range, you will be having a wider IB. Right? It doesn't make anything, but the only thing is that only as an intraday trader you can take opportunity on these days. As an intraday trader, you have the 65% of the time you're going to face this normal days. You don't know which day is going to be a normal day, but there is a possibility that 65% of the time that day could transform into a normal day. And next comes the normal variation day. That's what most of the players love, normal variation day. If you're an intraday trader, if you're a positional trader, they can make use of it. And it happens 20% of the time. Most of 20% of the time, you're gonna face 20 to 25% of the time you're gonna see normal variation day, where the IB breaks out on one of the side and it continues. This is where the IB breakout, the open range breakout players love these kinds of games, and that is only 20%, right? And this is where the IB will be relatively small. Let's say the IB will be relatively small, and the range extension will be 2 times or at times even 3 times of IB. It can be more than 3 times of 2 times of IB or 3 times of IB, or it can go to 4 times of IB also. Right. So the range extension will be very lengthier, and people love that because market really trends on that particular day. Whereas the morning you will be seeing some rotation, and the evening there will be a second half, there will be a clear rally. Till the day end, you will be seeing a rally. That's what the normal variation day is about. Typically, we call that as an imbalance profile because it's a trend, kind of a trending day, and the range extension is more than 2 times the initial range. OTF is in control. Clearly, OTF is in control here because the IB is what intraday players dominate, and the IB has been broken out, and that it has been broken out by a significant amount, and the range extension happens more than 2 times of IB or 3 times of IB. So there is a directional control from the OTF buyers in this case. If it is happening on the downside, then we can say like OTF sellers are in control on that particular day. And a trend day is nothing but, as I said, the one time framing happens, it never fades at all. If you look into the one time framing, the one time framing usually happens like this. And when most of the short term traders, when it is happening on the profile side, they will be thinking that this market is going to fall. It's going, people are not comfortable with these kinds of price action movements when the prices keep on one time framing throughout the day, right? So you see this in this case, price opens here, it tried to took the day low, but price started coming back in. And lately, the point of control is started developing on the higher side, right? That is a bad seller confidence. Initially, sellers showed up. Initially, they tried to push the price down, but then they eventually came back in, and the point of control started building on the higher side. That is a bad selling confidence. If it is a good selling confidence, the price would have been trending down. They don't make point of control above the previous day's low, right? So, and all in a sudden, if you're seeing that one time framing is happening on a trend day, at the max it can break only once, and it again does a trend following. These kinds of setups happens once in a month or twice in a month. These kinds of trend day setup happens. It's very, very rare. It doesn't happen very frequently. Very, very rarely in a month you can get 1 or 2 trend days. That's that kind of days. Most of the market participants are active on one direction. All the intraday players, short-term players, long-term players and intermediate players, everyone aligned in the same direction. On that particular day, we don't consider any point of control. Nobody is in control, so there is market is not in equilibrium point. So even if there is a POC here, we don't consider that there is no point of control formation on that day. That means market is not in equilibrium. Market moves. Market, when it comes to equilibrium, it comes into a balancing mode. Like let's say market is doing this kind of balancing activity and point of control is building in the center. Then we say that this is an equilibrium point. But on a trend day, there is no equilibrium point. Even though your software plots a point of control, on that particular day, nobody is in control. I mean, there is no equilibrium point for the day. And typically the only inventory pileup happens. Inventory pileup keep on happening from every time frame players, but there is no inventory correction at all. Next comes the double distribution day. Again, it's to some extent it's quite common. In a month, you can see 2 or 3 double distribution days, and it'll be separated by a single prince. It's 2 distribution, 1 distribution here. This is one of the distribution, and the second distribution here, which is separated by a single prince. As I said, we give importance to the single prints. Those single prints are our reference level. If you're finding 2 distributions, then we take that as the top of the balance. If the day ends higher, then we use this double distribution single print as our support zone, right? So use this as a support. Whereas if the day ends down, let's say this is a double distribution day. Initially the balance was 1 at the top. Market went down and creates a second distribution. Then we will use the bottom of the distribution balance as a reference for resistance. So that we'll be using that as a resistance. Whereas here in this case, we use this as a support. Right? This is a bullish case and this is a bearish case. For example, I also yesterday spotted a double distribution example, right? So, and we used to monitor confidence at those reference level. We used to monitor. So, for example, here is a Nifty, and one of the day we got a double distribution balance. So here is the double distribution balance. Here you can see there's one of the distribution here, and the second distribution over here, right? And when that particular day market went on the downside, right? So we use the bottom of the reference line as our reference for measuring that is our resistance level. That is our resistance level, and we used to monitor confidence over there. So think about here. So how we can deal with this next day? Next day, when the price is approaching that particular day, right? But every time the price is approaching the day, we're getting a sell-off. Again, price is approaching the day, we're getting a sell-off. Again, price is approaching the day, we're getting a sell-off. That is not a good buyer confidence. If it is a good buyer confidence, when the price is going up, they will accept above this reference. More activity happens in terms of time, and more price will be spending more time. That will be a bullish scenario, right? Whereas what is happening on that day is price went up, initially buyer showed up, but then they are responded by sellers. Again, buyer showed up, they are responded by sellers. Again, buyer showed up, they are responded by sellers, which is not a good setup, which is a mean reversion. It is one of the strategy where you can expect a mean reversion game there. You can look for a sell-off there. What you can expect is you can expect a sell-off there, because the buyers are not serious. When buyers are not serious, sellers will take control in the markets, right? So that's what precisely it happened on that particular day, right? So you can see that letter A period, it went up, and again it fallen back. B period, it went up, it fallen back, and C period, it went up, it fallen down. I will call that as even though price is trading inside the range, we will say like it is a low confidence buying, or it's a poor way of buying. It's not a good buying at all, right? So if it's good buying, as I said, point of control has to build above that double distribution reference level. So that's from the double distribution reference level are important to us, because it gives us a reference to create an solid support or a resistance. If yesterday's sellers are there, they showed up. If these sellers are serious today, they will come and defend at those reference level. But you cannot use that as a stop loss zones. You can only use that as a monitoring reference. You can use only as a monitoring reference. If the yesterday sellers are serious, definitely they will come and push the price again and again, and they will not allow the point of control to build above the double distribution reference. Any questions here? Any questions? Okay, if there are no questions, then I'll move ahead. Okay, recently there are not much of a double distribution anywhere.
Hello.
Yeah.
Rajendra and Rohit here. One question I have is I usually go with the futures and I hedge with the calls. I am a swing trader. Whether any of these days would be helpful for me to understand the direction of the market?
I'm sorry. Can you repeat your question once again, because I'm getting a low voice?
Yeah. So you're able to hear me now?
Yes, much better.
Yeah. So I usually go with the swing trading. I usually go with the futures.
Okay.
And usually with the selling the calls. But
okay, got it.
Nowadays, what is happening is I'm not getting a particular direction.
Okay.
So before few months back, I usually used to get a direction. So now what is happening is there is no direction to the market at all.
See,
so
every time the market landscape is going to change. Markets are going to trend only 20% of the time, 80% of the on a higher time frame. Okay, on a lower time frame, as I said, most of the time you're going to see a normal day. So most of the time you're going to see market it's going to be balancing, right? So volatility was high during last year. Volatility was high, but if you take 2017, volatility was low. Everyday markets are grinding only. 2018, you're seeing some good volatility. So maybe if you use ATR, like some filters like ATR, right? So you'll be able to see if you want to trade mostly with trend days, let's say with a good volatility range. I think probably you're talking about volatility. You're expecting some directional movements, very good swings. In such a case, you can use some tools like ATR kind of tools, right? So for example, one of the tool which I designed, it's called PRB ATR. Maybe you can go and work on this literature. So this will help you to change, predict change in volatility. I'm not going to discuss much about this because what I can go is you can go and study this thing. That will help you to look into what you are exactly looking for. Probably you're talking about these kinds of volatility, like kind of directional movements, again directional movements, again directional
Yes.
movements, and directional movements. But now what we are seeing is a kind of a dull, boring markets, a dull, boring markets, a dull, boring markets. How you can spot those things? That's what the answer is over here. I request you to go and look into it. I'm going to share this link in the Market Pro AMI Broker channel. You can go and study it.
Sure. Thank you. Thank you.
Right. So, and that is nothing related to market profile. Market profile is no matter whatever the landscape is, whether you are in a trending landscape or a sideways compression landscape, how you can make use of any kind of market situations. That's what we're going to talk about over here. Right. So yes, can I predict that day could be a balancing day? Yes, you can do that. But I'm going to talk about it, which will be coming in open types. When it comes to open types, I can tell you when exactly we can expect this kind of dull, boring activity, right?
Rajinder,
Yeah.
I have one doubt. For suppose it formed like double distribution day.
Yes.
So once break the single pattern form is there right now. G
Yes.
ladder is a common single pattern. So if break that level, we can consider that like support.
If they are serious sellers, let's say this is a double distribution, right? So double distribution, middle of the day you'll be seeing, and there'll be a price will be balancing. Price will be balancing, and it will be breaking the. You see that in this case, it is breaking the day low. It's breaking the day low. It broken the day low, and it's coming back again. It's selling off, coming back, selling off, coming back, selling off. You see that the point of control got shifted over here. Point of control. Initially, your value area will be here. Initially, your value area will be here. You will be seeing that price will be coming down below the value area low. You may think like it might be a serious. You might be thinking that they are emotional sellers, right? So that's the thing will be running in your mind when you're seeing this picture. But if they are serious sellers, they will not fade this single print at all. So you'll be seeing that point of control migrates. Point of control migrates, and then single print is not getting cleared. That is a sign that it is a good selling. This single print is also one sign of a good selling. Single prints, one time framing, they are a sign of a good selling. In this case, right? So if it is market is going down and you're seeing single prints, which is not cleared, it is a sign of a good selling. And that is also a sign of a good confidence.
Okay, Rajendra.
Yeah. So again, neutral extreme day. Neutral extreme days are quite rare, and it is also it mostly comes mostly at the market tops, right? So the only thing is that IB got broken on both the sides in this case. The IB got broken on one of both the sides, and the market closes at one of the days extreme. So in this case, we call this a neutral day extreme, and it mostly if you are seeing in a good uptrend, right, followed by that you are seeing the IB got broken on both the sides, and it ends here, and it is coming at a major swing high. And maybe tomorrow, if some other announcement is going to be there, or some news is pending, or some GDP announcement is pending, and you are getting an neutral extreme at the major swing high, and probably a call writing is happening at the top. It's a sign that we almost reached the market top. Maybe we can expect some short-term downtrend from here onwards. So neutral extreme day, if it is coming, you have to be really cautious if it is coming at a major swing high, right? So there are times what happens, the market will be moving in a good swing. You'll be seeing a neutral extreme one of the days where IB got broken on both the sides, and again IB got broken on both the sides. IB got broken on both the sides, and market moves up, and then it used to fall down. So you'll be seeing a neutral sequence of neutral day types. So when you're seeing all neutral extreme days, we call it as NE days. NE. You'll be seeing a sequence of NE days. Again, that is also mostly kind of a distribution phase. Mostly market tend to do some sort of a distribution in any days, neutral extension, right? And then followed by one spike. Everyone think that the market is going to go up, and where probably the call rating will be happening over here, not in this phase. Neutral call rating will not happen in this phase, whereas a lot of call rating will be happening in the zones. Market will not be able to breach, or it might breach and then it falls down. So, but neutral extreme day, which is happening in this zone, if a major swing high, neutral extreme is happening and call rating is happening over here, that is a sign of a top, right? Whereas if the neutral extreme is happening in sequence, one of the day, second day, or third day, even fourth day, all the days are neutral extreme days, and the call rating is not happening, it's not a sign of a market top. And let's say they could smash up, and then where the call rating happens, and then they take it down. It's a sign of a distribution. It is a sign of a market distribution. Next comes the neutral day center. Neutral day center, it's nothing but a doji candle, like where more activity happens at the center, you'll be getting a prominent point of control. IB got broken on both the sides. Both the sides IB got broken, right? And price closes at the center. Price closes at the center, right? So these particular days are dull, boring days. It used to happen at many various locations. Neutral day center, it used to happen at most of the trade locations.
Rajendra, what is the difference between neutral day and normal day? How we can differentiate?
Normal day IB will be broken on one side, whereas neutral day IB will be broken on both the sides. The range extension happens on both the sides. So normal day, the OTF will be present only on only one direction, whereas the neutral day, the OTF will be fighting. The OTF buyers and OTF sellers will fight, and price close at the center.
Okay.
Right? Yeah. So in both the cases, in both the neutral day extreme or both the neutral day center, IB breaks out on both the sides. The initial balance broken on both the sides. Next comes the P-shaped profile. P-shaped profile is very interesting setup. Whenever you're seeing a P-shaped profile, market don't give its uptrend easily. So a P-shaped profile will be starting like that. Always the open starts at the bottom. First 1 hour will be the rally, and then lately the second half market balances at the top. It is nothing but a fresh money buying. New money is coming into the markets, and the old money is going out of the market. The first 1 hour, there will be a short covering rally. At times, the short covering rally will be combined with fresh money buying. So old money goes up and fresh money comes into the markets. And at times, it could be only old money getting out of the system that you can be able to gauge from the volume which is happening over there. So in a P-shaped profile, you have to look into the volume, how the volume is happening. If the volume is tremendous, probably it is a combination of old money buying, old money exiting out of the, old shorts are going out of the system, and new money is coming into the markets. But if the volume is moderate or less, maybe it is only short covering rallies. So if the volume on that particular day is relatively higher, then the P-shaped balance acts like a support zone. This we'll be drawing a reference line at the P-shaped balance, where you see that there are a lot of single prints over here. These tails, those tails will, those are the zones. We'll be using that as a reference, and that act like a support zone. So we'll be monitoring every time. The very next day, what happens? Price opens here, and all of a sudden it comes to a break. But again, buying happens over here. If the volume is higher here, if the volume is higher over here, that means it's maybe kind of some sort of an institutional activity would have been happened. If these guys are serious, they will come and defend at these P-shaped balance reference level. Every time the price comes and breaks, and you're seeing that point of control is building above this level, it is a clear buy. The trend could resume from there onwards, because P-shape indicates fresh money buying. When fresh money buying is there, if they are serious buyers, they come and defend those P-shape reference levels, right? So at times it could be a combination of old business exiting shorts and new money buying. So that you can confirm from the volume. And these kinds of P-shaped profile, it usually happens after a a good downtrend, market will be balancing, and after that balancing, we will be getting a P-shaped profile, right? And when you are seeing this kind of P-shaped profile, the length of the P-shaped profile will be relatively large. If it is in stocks, first 1 hour itself, we'll be seeing that 2%, 3% of activity will be happening. Rest of the day, market will be dull, boring markets. So you can take that as a reference. So even if you haven't entered in this P-shaped profile and market is throwing some opportunity here, you can re-enter at these trade locations. Even you can go and re-enter these trade locations, and you have to monitor that reference. Point of control, never it should form down below P-shaped profile, right? A point of control can form if it is, let's say it is only a short covering activity, volume is very thin, and in that case what happens is that they will plunge, but eventually they will rotate back, and they will provide supports over there. But you can find very difficult to trade P-shaped profile with low volumes. If the volume is relatively low, they can break, but eventually the point of control will be still forming above this reference level. It will be tough to trade the P-shaped profile. But if the volume is relatively high here, even a touch, they will come and defend. Or if it's a good trending market, what happens? A P-shaped profile will be followed by another P-shaped profile, another P-shaped profile like this. If the markets are moving with a greater strength, don't fight for the downtrend at all, right? So these are the places, don't fight. If we are seeing a back-to-back P-shaped profiles, not a good place to fight for a counter trend reversals. It's a continuation of the trend. You're getting my point. More and more fresh money is piling in. So you should not fight the markets. You should either go align with the markets or don't. Better don't. And next comes the B-shaped profile. B-shaped profiles it's nothing but kind of an inventory correction. Then what happens here is that generally in a good trending markets, all of a sudden one of the day market breaks. Despite everything, despite all the bullish activity, market breaks, and remaining of the day market tend to balance. You see a form of B-shaped formation where the opening will be at the top. You can see the opening will be at the top. Price breaks down, and the distribution happens on the bottom side. In that case, again, the bottom of the balance stop will be considered as a reference line, and that is a short-term reference. It doesn't matter whether it's a P-shaped profile or a B-shaped profile, or a double distribution balance or a triple distribution balance. All the references are short-term references. Means that references, we used to carry forward those references as long as point of control activity is not building above that or building below that. So in the B-shaped profile here, it's nothing but the old money is getting out. Whoever made some longs here, maybe institutions, for example, let's take a hypothetical example. Let's say institutions piled up here, and some other players are coming and piled up here. They accumulating here, and all in a sudden, maybe the guy who already entered here much, maybe he want to do some partial profit booking, or he want to unwind some of his position. They will come and do some profit booking there. They do profit booking there, and that is what we say, like it's an inventory correction. They remove some of their, let's say I bought 1 lakh quantity, I'm sitting on a good profit, so I'll offload some 20% of my quantity here. So I'll offload 20,000 shares of Reliance, so that I will dump it in the market and I'll book my profits. That dumping, most of the dumping will be like, all of a sudden you're seeing a sharp fall in the market. They're mostly long liquidation. Markets will fall not because of someone is shorting it. Market will fall because of somebody is liquidating the markets faster. So they might be doing some partial profit booking and they will dump it in a short. That is why you'll see a sharp drop coming into the markets. All those sharp drops, a slow drop could be an short selling. This could be a short selling movement, right? This could be fresh money shorting the markets. But if you're seeing that markets are doing fine and all of a sudden you're seeing a sudden drop, you see that tempo means how fast the market is moving. So here the tempo is slow. Markets are relatively moving really slow. Whereas here the tempo is fast here, where the drop is coming significantly faster. So that is how most of the B-shaped profile will look like. Most of the B-shaped profile will not fall very slowly. This doesn't happen, but market fast, there will be fast fall, followed by that remaining of the day, there will be a balancing activity coming in. So that looks like a B-shaped profile. A fast fall is, or a fast rise is that is what it defines a T-shaped profile or a B-shaped profile. And so the tempo has to be really fast over there. That usually indicates inventory correction or a long liquidation. That's what we call the term as long liquidation, right? So what is the impact of the B-shaped profile is that not in fact B-shaped profiles are kind of an temporarily bearish, but it resumes its bearishness. We use this as a reference. It will be temporarily bearish, but once they take the reference level, they will be taking the reference level. Once they take the reference level, market tend to become a bullish mode. So most of the times this bearishness can last up to anywhere between 2 to 5%. In most of the cases, 5% of when you're seeing a B-shaped profile, you have to be really cautious. You have to tighten your stops when you are trading a B-shaped profile, and when you want to short the market, right? You have to tighten your stops because there will be a temporary weakness. You can capture the temporary weakness, but that temporary weakness can anytime it can turn. When it is turning, it is accepting above the B-shaped profile. Your point of control starts one of the day. If the point of control starts building above point of control, that is a bullish setup. That means a sharp up rally. Again, players are again going to pile up. Maybe they are accumulating phase. They are accumulating here. They would have been accumulated over here. Here the liquidation happens. The B-shaped profile liquidation happens. Maybe some more temporary liquidation. Once the liquidation phase is over, again the accumulation phase happens. Again accumulation phase happens. Again accumulation phase happens over here. People will be again piling up inventory. They pile up inventory. They liquidate. Again they pile up inventory. That's how the bull market. Most of the bull markets moves in this manner. So again, B-shaped profiles are quite rare. Hardly every 3 months once you might find it. It doesn't occur very frequently. Even the P-shaped profile is somewhat frequently happens in the markets, and at least V-shaped profile is very, very rare. You may not be able to spot in every cases. Again, all these are textbook examples where the trend day, non-trend day, and normal variation day is where you get lower risk-reward ratio. Not much of risk-reward ratio for an intraday trader there. Normal day, an intraday trader can benefit, but an positional trader cannot benefit out of it. That day is quite significantly large, 65%. And normal day, normal variation day and neutral day is what most of the people love it, because the market most of the time it shows a nice clean trend over there. P-shaped profile and B-shaped profile mostly, and apart from intraday players, the positional players also benefit out of it. P-shaped profile means new money buying, new business is coming into the markets, whereas the B-shaped profile is only talks about old money is getting out of the system, old money is liquidating their business. Right? And trend days and double distribution day are the one which gives very higher risk reward ratio. Double distribution day is also one form of trend day, right? So the only thing is that trend day, there is no point of control at all. That means market haven't attained its equilibrium, because on a trend day, only inventory pile up happens. There is no, the inventory is not released into the system at all. So people might be getting long too long, or the inventory pile up happens. The trend day doesn't mean like tomorrow it has to continue. Either it may continue or it may completely remain revert. So none of the days are bullish or bearish. But if it is a P-shaped profile, it means new business is coming in. If it is a V-shaped profile, it means old money is getting out. If it's a double distribution pattern, then it builds a resistance level. If it's a if it's a downtrending day, or if it is an uptrending day, you are seeing a double distribution. It will act like a support zone. If the buyers are serious here, who left the single print tails, then they will come and support at their trading prices. So that is quite crucial over there when it comes to double distribution. Very rarely a day could evolve into a triple distribution day. Let's say a day is evolved into a triple distribution day. So one more distribution, and one more distribution, where all the distribution will be separated by a single prince here and one more single prince here. If the market went down, then probably you can use that at the top of the distribution as your reference, and that will be your resistance bands.
Rajendran, question in this.
Yeah.
Depending on the profile types, you are saying the risk reward ratio. Now, just earlier what we saw is that the shape of the profile is only visible, or it will only be identifiable for during the late in the sessions, right? So, what is the risk reward ratio that we're talking about when the profiles have already formed?
No, this is generalized view. It depends upon which is having a directional movement. So where the trend days and double distributions days are having a directional movement, and P shape and B shape has a little bit of lesser directional movement compared to trend days and double distribution days. Whereas normal variation day and neutral day are still rewarding, but it is compared to the reward is very higher if you are catching the trend days or double distribution days earlier, right? So whereas the volatility in non-trend day and normal day is very less. That's the argument over here. I'm not talking about the trader's risk reward ratio, but as an intraday trader, more benefit will be there from while catching the trend days. You onboard the train and it moves in your favor faster. Whereas if you're coming in a normal day, right, and you're getting caught in the middle, then you'll be part of the rotation. Then activity happens, right? That's what that's what explained over here.
Okay, Rajendran, thanks.
Yeah.
Rajendran, I have a doubt.
Yes.
So for the non-trend day and the normal day, the difference is only the IB is wide in the normal day?
IB is wide in the normal day, whereas IB is very small in non-trend day. Even in a normal day, IB cannot be broken, but IB will be wide. Maybe it can be 60 to 80 points in Nifty, and still IB might not be broken. Or if it's breaking, it will be breaking only one direction only. Right? If it's breaking on both the direction, it becomes a neutral day. Either neutral day center or neutral day extreme. That's the difference.
Okay. Then for the normal variation day and the trend day, again the IB is only difference.
Normal variation day and trend day. Normal variation day, it's like the balance IB will be small typically, right? But most of the rotation happens initially, and lately by around 11 o'clock onwards, the breakout happens and it moves up. And maybe it is not an it will be a directional movement. It will be a directional movement, but it's not one time. Not necessarily it will be one time framing, right? Whereas in a trend day, we are mostly talking about one time framing.
Okay.
Trend day will be one time framing. Hardly it ends once, and it keeps moving and moving and moving and moving.
Okay.
Right.
Thanks.
So trend day is all about one time framing, and double distribution is all about two distributions separated by a single prince.
Single print. Yeah. Thank you.
Rajendran, Harsha here.
Yeah, Harsha.
Rajendran.
The question is, if if we come to know within 1 hour at least, within almost 10-15, if we come to know what is the day will form.
No, there is no point of doing that. There's no point of doing that. What kind of day? These are just day types. Don't try to predict what day it is supposed to be.
Then how? Say if I am a long, if I come to know it is a 10 day at 10:15, I would have hold my position till end of the day.
You never know. Only you can realize all these things. See, a P-shaped market at times, what happens? Market it does a short covering rally. Market will be distributing, right? So you'll be thinking that this will be a P-shaped profile day. All in a sudden, what happens? Market crashes. So what I'm saying is that don't try to predict. End of the day, you'll be looking into a different markets. By predicting these days, you're not going to get anything out of market profile. These are just profile days where you can infer some information from this. Like I said, double distribution, you can infer that there'll be a resistance formation over there, which you can use it as a next day's level to monitor. So if you are seeing that price is rejecting that will be one of your trading strategy where you can go and enter long or short at that location where your risk reward ratio will be favorable. you'll be getting a risk reward ratio around 1:3 or 1:5 levels. Your entry point will be, you'll be very close to that particular day's top or a bottom. If it is a P-shaped profile or B-shaped profile, it has its own trading characteristic. If it's a neutral day center, it having its own characteristic. It is one form of an kind of a market top, or it comes very close to the market top, right? So otherwise, most of the days are going to be normal day, and 65, that itself eats 65% of the time, right? So there is no point of predicting what kind of day it is.
Yeah, got it. So is there any mechanism, I think you may going to tell in future, so I can hold, say if it, assume if it is a trend day, it is going to form a trend day. I have taken a position at around 9:30 or 9:45.
Yes.
Is there any mechanism in future you are going to tell I can hold till end of the day?
So what you can do is, let's say you're initially seeing that one time framing is developing. You never know whether that day going to be and transform into a trend day or not. No one can know about it. But if you're seeing that one of the day it's breaking by 1 point, again it's resuming back, and that is one of the place you can onboard. Even if you are not part of the game, you can onboard it where your stop loss is very tight over there. Your stop loss is very tight over there, and you can anticipate a trend day, right? Again, the trend day is developing, you can be part of the throughout the day. But that day is very, very rare. Not every day the market develops. Not every one-time framing. There are times what happens, market one-time frames, right? So confidence will be higher throughout the day. But the remaining days, it could be doing something else. Again, it resumes back. It could be one-time framing against the high confidence, like we said in the last minute. Anything can form. What is your job is to interpret what is happening right now, and what kind of confidence is going on. If certain confidence is higher, should I have to continue in the market direction, or should I have to reverse my direction, or is there any risk which is there in my in holding my positions? That is the only thing which will drive you to trade any kind of trading day, right? So whereas trying to figuring out whether the day will form as a P-shaped profile or a B-shaped profile, I don't find any significance in predicting the day type. Nobody can predict, frankly speaking, nobody can predict the day type. I cannot say like today that it will be a P-shaped profile. Today it will be a excess. Today it will be a failed auction. I cannot predict. There is no point of predicting this information. But when certain information is forming, how to make this information useful in your trading right now, and what you can infer from it. Are you seeing this information as a risk? Are you seeing this information as a resistance? Are you seeing this information as a support? That is the only thing which keeps you to the next level of trading.
I guess, Rajendran, yeah, that's exactly right. I think, for example, if it's a P formation, right, use that information for either holding the positions or
exactly.
Yes,
whether you should continue your positions, or what level you are going to get out of your positions. That is what it tells you all about.
Whether you are short, P formation will tell you that the short covering has started.
Yes.
And you need to start.
It only talks about what kind of market activity is happening. If certain activity is happening, who is responsible for that, and what level I should monitor the subsequent days. That's what. That's how we can use this profile distribution type.
And use that information to position or to adjust.
Yes, exactly.
To change.
Yes.
Rajendran, I have a doubt. Like from these profile types, can we infer any market confidence for the next day?
No, market confidence is like something like the which I'm going to talk about in the afternoon session. I'll deal with.
No, not actually like specifically the confidence, but any kind of information. Since we can't predict the current day profile.
Yes, you cannot predict the current day's profile. It's not like you cannot predict the current day's profile. You can predict to a certain extent. Some of the days you can say like the day could transform like this. The market could test a day high. Market could test a day low. You can predict certain things, but you cannot say like this day it will be a double distribution day. This day could be a trend day. You cannot say like that. But you can say like first half market will be balancing. First half you can expect ABCD balancing can happen. The second half there could be a rally. Like that you can predict, but you cannot say like this day could be a trend day. this day could be a double distribution day. That kind of day type you cannot predict. But if the market is doing some activity, you know that based upon this activity, what could happen and why it should happen, that kind of reasoning we can give.
Okay.
Okay, but predicting the day types, it's total nonsense.
Rajender.
Yeah.
Yeah. Sometimes B shape, P shape and B shape is formed simultaneously.
Okay, you're talking about like
P shape and B shape.
Market.
Yeah. B shape and B shape simultaneously form. What is the market indicates?
Let's say, can somebody who is switched on their webcam, can they turn off? Shresha. Yeah. So let's say your question is about there is a B-shaped formation and then followed by a P-shaped formation, right? Is it something like this?
Yeah.
So that means today there is a long liquidation, which is a temporarily we are going to see a downtrend. So where your reference levels are B-shaped level, activity started happening. Anything activity started happening above B-shaped reference level, it's going to be a bullish setup, right? So that means now new money is again started resuming their operations again. So that means again you get an more reference level. Again, market might be started doing something else. Again, they might come and take supports over here. Every time the price comes and dips over there, you may get some support at P-shaped reference level. At times when there is a P-shape is running on, when the one of the day market, let's say the institutions might be pushing the market higher. Maybe I'll draw a little bit bigger. One of the day, the very next day, the price comes and snaps back, and it forms a one more balancing area, and it can happen twice or thrice in a row, and that will be continuing, and followed by that, the operations will be resumed from the subsequent day onwards. So that kind of, if the institutions are very strong, they will strongly defend at these locations multiple times, even second time or even third time, they will come and defend at those low locations. So the P-shaped profiles are always interesting. Again,
yeah. For suppose it will break P-shape.
Yeah, it could break P-shape also. That's why I said if there is no institutional presence, if a P-shape profile can come and form at the major market tops also. So if the market tops, if you're seeing a P-shape profile, and this is not the volume is not that serious, and next day what happens, market opens here, and you'll be seeing like this. You'll be seeing more activity coming here, and market tend to go down. If this is not a serious volume, price accepts below the P-shape profile, activity happens below the P-shape profile, point of control migrates over here, that it's a sign that we are gonna see some temporary downtrend. But in my opinion, if a P-shape profile, any major market top is coming, right? If the P-shape profile it's coming at a major swing high, you can see a temporary downtrend. These temporary downtrend can go up to 5 to 10%, but eventually again they will scale it back. Eventually they will scale it back, but based upon what location the P-shape profile is coming in, it matters a lot. So at times a P-shape profile can come at a downtrend also. Like say there is a downtrend, one of the day what happens, price opens gap down, and they come back in, and it forms a P-shape profile where the volume will be relatively high. The volume will be relatively high, institutional presence will be there. That P-shape profile acts like a support.
Volume, how much volume we can expect, Rajendra?
So we need to look always from the relative terms. Let's say the volume was compared to last 30 days, it is quite a big volume. Or last 15 days compared to that, it's big volume. Always it is in relative terms. So if it is something like a Nifty, let's say Nifty, if you look into Nifty, every 5 minutes, we have to keep remember this, because we'll be talking all these things in order flow as well. Most of the 5-minute charts from a relative terms, 2000 lots getting traded on a 5-minute time frame is a decent volume. And if it is going above 4000 lots on a 5-minute candle is a bigger volume. Likewise on a hourly time frame, If it
In
is
5 minutes means 4K in a 5 minutes, huh? Almost.
yeah 4,000 lots in a 5 minutes.
Actually, sir, I have seen, in a 5 minutes maximum, I have seen, especially in the opening itself, I have seen maximum 600, 700K. But
Not
2000,
600K, not 600K. I'm talking about lots, 6,000, 4,000 lots. That is 4,000 into 75. 4,000 into 75. I'm talking in terms of lots.
yeah,
Okay.
sir.
So whereas at the open, at the candle opens, mostly you'll be seeing anywhere between 4,000 to 9,000 lots on a non-even days. On even days, it can go up to 9,000 lots to 16,000 lots on a 5-minute candle. 5-minute candle. This is from Nifty perspective. On a hourly time frame, it will be anywhere between.
Nifty. See, sir, I am seeing Nifty 5 minutes candle.
Mm.
Even in the open itself, even if I take 4,000 into 75 means 3 lakhs volume.
Yes.
I never see, sir. I have seen maximum is 600 to 700K.
You mean to say that 60,000 lots?
I don't know. I'm not.
6 lakh lots. 600K, 6 lakhs.
6 lakhs, sir.
Yeah.
So you are telling, serious lots means, 4,000K means 4K.
I'm talking throughout the day.
No, sir, 5 minutes we are talking here.
So maybe I can show you one of the example.
Yes,
there is a new indicator which comes in from Bell TPO. Like
that would be great.
I'm gonna show you how it looks like. I'm gonna import that. I should have done some time back, but let me try it out now.
Sir, I think we should not disturb the flow. We can take it later also.
Okay. That makes sense. Anyways, nothing much for an IB. From an IB perspective, non-trend day will have narrow IB. Normal day will have a little bit of wider IB. Normal variation day it's a smaller IB, right? So nothing much. It's relatively compared to normal day is relative to lower IB. Trend day IB is narrow and shallow. Double distribution day again narrow and shallow. Nothing much. So next comes the market opening.
Rajendra?
Yeah.
Yeah. Can you show the recent example of P shape and P shape?
Yeah, I can.
Nifty.
I don't think there's one P shape profile came, but that volume is not significant recently. Here is one P shape profile. One of the day, very first day they defended, but second day they given up. So here is a P shape profile.
Yeah. That is a P shape, and next day is formed the B shape.
It's not a B shape. It is not a B shape, by the way. It looks like a B shape profile. B shape profile, mostly it's liquidation. The liquidation will happen. Like it happens, and then there will be sharp liquidation, followed by that a B shape activity will be there. Right? You'll be seeing the letter A and B will be liquidating really fast. Whereas this, we don't see that as a liquidation. This is very thin when compared to B and B shape profile. Maybe B shape profile. Recently, I don't find any B shape profile.
That volume is also very low.
Yeah, volume is relatively low on the P shape day. If you look into the day's volume is relatively low. But yes, that is our reference here. So we'll be still using that as a reference. Still, no matter what, whether volume is high or low, we'll be plotting a reference line over there at the P shape profile. So here, that will be our P shape profile reference will be plotted over there. And they generally defend at those locations. If they are serious buyers, every time you are seeing late sell-off, you'll be seeing mostly late sell-off. More activity happens, late sell-off happens, and then middle of the day they come and break, but they resume back and they resume back their operations most of the times. And then Bank Nifty, do we have any P-shape profile? There is one P-shape profile on 28th of December. Again, the same setup in Bank Nifty as well. This zone will be acting like a support zone. And if they are serious, every time the market used to every time it used to come down, the buying happens over there. So in this case, more activity is happening, and then buying operations again started resuming back again here.
Rajendra, can you go back to the P shape on 28th December?
December, yeah.
I think, so we had a question, how do we, utilize the formation, right? So I think this is one of the example where if there's a P formation and see the action on the 31st December,
yes,
and then the first Jan action, as you said, the people will defend, or institutions will defend those levels, and then now it has
multiple times they're defending over here.
Right.
It's not an easy giveaway there. So they do give up, but it's not an easy giveaway. Finally, it takes one of the. I'll be carry forwarding the reference as long as that level is not broken. So one of the day this level has been broken, point of control is started accepting down, and the price is going down. So that's why we can say like that reference level is broken. Then I'll remove that reference. Until then, I'll carry forward that reference as long as price is not willing to go down below that reference level. Okay, so let's go back to the basics here. Let's talk about the market open types. We have 5 open types. The market open types are nothing but the subset of the market confidence, which I'm going to talk about in the afternoon session. So these days we don't talk about the opening times. We'll be mostly talking about only about the confidence, because that overrides the market confidence rule. These are basic textbook styles, right? So even now it is not part of Jim Dalton's concept. He completely moved into market confidence. What we are talking about is an elaborated market confidence, which we want to talk in the afternoon session. Now, this is a textbook style. It is again nothing but one way of measuring the market confidence at the market open, right? So, the basic foundation for the market confidence at the market open. So, open test drive is the first one where you can get the maximum confidence, and open test drive is slightly. It's still a high confidence. These two talks about high confidence. These two talks about high confidence. Open rejection reverse talks about bad confidence. Open auction in range, he talks about no confidence, and this again it talks about no confidence. So this talks about open drive talks about high confidence. Open test drive again talks about high confidence. ORR talks about low confidence or bad confidence. Open auction in range talks about no confidence. Open auction outside the range talks about no confidence. Means when I say no confidence, neither the buyers are serious nor the sellers are serious. When I say low confidence, that means if the buyers are showing up, but still they are not serious buyers. Usually it evolves into a trend reversal. When I say high confidence, buyers are serious. If the markets are going up and you are seeing open drive or open test drive, they are mostly serious buyers, right? So first we'll look into the open drive, which is a high confidence setup. Usually you can we have a previous day high and market opens gap up. Gap up itself a sign of a high confidence open, and post that what happens is that the bottom will be made in the first 30 minutes itself. The bottom will be established in the first 30 minutes itself. That is the key here. And that gap will not be get filled at all. The gap will not get filled at all, and it tends to move in the direction you'll be seeing point of control initially here. Later it will be migrating over here. You'll be seeing point of control migration over here. So that's how an open drive will test up. So market opens gap up, and there'll be a drive, and there will be a drive that shows the maximum confidence at the open. And I can show you one of the example here in Nifty. So most of the P shape, look into this P shape profile this particular day. Price opens gap up, that is price opens above the previous day high. It took a straight drive, and it forms an, this is an example for an open drive. This is an example for an open drive where the confidence was higher throughout the day. Throughout the day, the confidence was higher. Never the confidence changed anywhere in that day, right? And rarely the confidence changes once, very rarely it changes once, either from high confidence to low confidence or low confidence to high confidence. But on a day like a P-shaped profile, it opens with a high confidence, it moves up, and that confidence stays throughout the day. So it's completely high confidence day, right from the start till the end. Means if you're measuring the confidence at 9 o'clock, 10 o'clock, 1 o'clock, or 12 o'clock till the day, the confidence will be remaining high confidence. Never ever it would have been changed. Right? And open test drive, it's the same setup. The only thing is that price still opens gap up. Price still opens gap up, and it opens above previous day high. It opens above previous day high. But it tested below the day low, and it comes back into the range. It comes back into the range. But still, you'll be seeing that point of control. The remaining day activity will be started developing on the higher side. Point of control will be developing on the higher side. If you look, that point of control will be still building above the previous day high. So that means that day also, right from the start, it shows high confidence. It shows high confidence at the open, and as the day progress, A, B, C started developing, point of control will be always above the previous day high. It never went down anywhere here or anywhere here. Point of control will be completely staying above the previous day high. So again, that previous day high will be acting like a reference for you to measure the market confidence. Right? So the only difference between open drive and open test drive is that both are high confidence market. Both shows high confidence right from the start till the day ends. The only difference is that open test drive opens with a gap up, it comes back in, and again it snaps back. Right? So there is no major difference between open test drive and open drive basically. We can also say that day as an open drive. Let's say the market opens here, and here is my previous day high. Market opens casually inside the range. It snaps back. It moves above, and activity started building higher, and it moves up again. Activity builds higher, and it moves up. This is also kind of an open drive, because right from the open there was a drive is happening. Not necessarily it has to happen with a gap up or a gap down. Without that also, price opens, it snaps above the previous day high, and throughout the day, point of control builds above the previous day high, builds above previous day high. That is also a classical example for a open drive. The only thing is that confidence remains high right from the start till the end. We call that as an open drive or an open test drive. Open drive. Yeah.
Where is the entry point for open drive and open test drive?
No, there is open drive, open test drive, and open drive is not a trading strategy. It's one way to measure the market confidence. Okay, that means when you are dealing with a high confidence market now, when you are dealing with a high confidence market, don't fight against the market. Either you go with the trend or you don't try to take a contra trade. Because when the market is exhibiting very good confidence, don't try to trade against it. That's what it means. The entry point, you can enter anywhere, right? So there is no definitive rule over here. But most of the open drive and open test drive, it bottoms out in the first half an hour itself. Most of the open drive and open test drive, it bottoms out in the first half an hour itself. So the day is low. If you're thinking that the market is showing good confidence, then probably that don't take the days low as the stops. Most of the people does that. Maybe it could be at some other point, definitely pretty close to that days low. Maybe somewhere in this band or somewhere in this band. But definitely don't keep at a day's low, because day's low and day high is where most of the traders, they keep their stop loss. Most of the stop loss players have a culture to keep their stop loss at yesterday's high, yesterday's low, previous week high, previous week low, multi-day high, multi-day low. That's where most of the people keep their stops. So I'm saying that it should be somewhere very close to that, but definitely not at the day's high. Maybe somewhere in this band. If you're thinking that market is showing good confidence and market is moving in your favor, you're anticipating some other levels on the upper side, If you think that day could be an open drive or an open test drive, your stop should be the first half an hour, pretty close to the first half an hour high or low. On a downside, it is an open test drive on the upper side. The stops should be on that day's low, because the market bottoms out in the first half an hour itself, if it is an open drive or an open test drive.
But Rajendran, how come we know that market will show open drive or open test drive in the initial after opening the market? Is it mandatory that we need to wait 30 minutes?
Yeah, market profile is all about 30 minutes, right? Market profile is all about 30 minutes. So if it's an open drive or open test drive, market tops out or bottom out in the first 30 minutes. So if you look most of the days, if you look most of the high confidence days, the market tops out or bottoms out in the first 30 minutes itself. Let me show you a couple of examples here. So you can see this example, market bottom out in the first 30 minutes. See this particular top, market topped out in the first 30 minutes. And let's take more examples on the downside.
So we should not take trade within 30 minutes, right?
Not every time. Not every time, but if the market is showing high confidence, let's say market is opening with a gap up and they're doing a straight drive, at times you have to be a fast trader and at times you have to be a slow trader. Right? So if the market is showing at the, when you have to be a fast trader and when you are going to be a slow trader, that matters a lot. So let's say I'm a fast trader. Let's say I'm a fast trader. Fast trader. If I am seeing a high confidence at the open, high confidence at the open, probably what I have to do is that, let's say this is this is my previous day high and low, and market closed somewhere here it closed, right? So next day markets are opening some 20 points higher and it started doing some activity. It's a high confidence movement, right? So it's a high confidence movement. What you can do is that you have to be a fast trader over here. You have to onboard the train faster, because many people try to fade the gaps. What I'm saying here is that you onboard the thing and you continue monitoring it. If the confidence is to remain high, what has to happen is that you will be seeing point of control building above. You'll be seeing point of control building above, and there is a possibility that that day could turn out to be an open drive day, right? So you cannot forecast whether the day is an open drive or open test drive. But let's say if the confidence has to remain high throughout the day, you're going to be an early buyer over there. If the confidence is not good, let's say market is opening gap up and all of a sudden it comes back into the range and it is not willing to go back. Instead, it is forming A, B, C. It is trying to do something like this. Maybe I can show you an example from S Bank. S Bank yesterday. Like S Bank. Minute. Okay, better I'll duplicate this. S Bank here. Indicators. So S Bank will be using a typically 10 paise TPO. That means I have to use TPO size as 2. TPO size as 2. Okay. Apply. So look at this example here. So what happened here is that on last Friday, what S Bank had done is, this is my yesterday's low on when I am seeing on the 4th January, right? So yesterday's low has been broken. 2-day, in fact, 2-day low has been broken. If I place a reference line at 2-day low, 2-day low. This is my 2-day low, right? So it has been broken at the B period. The B period came and broken Right? If they're serious sellers, what they would have done, they would have been done more activity here, and they would have elongated, and they would have been done more activity, and they would have been went down. But instead of what happened here is price snaps back into it. That is itself a very first sign that it's not a good confidence of the selling. Initially, selling confidence are there, but then lately that's why they've broken the 2-day low. But if the volume is not supporting at the 2-day low and price is snapping back, that is a caution sign that they are going to move to the other side. Something different is going to happen. One of the best place to initiate your longs over there.
I think we have to add volume here.
Yeah, you have to add volume also in this case. That's why order flow comes into the picture over there. Okay, so whenever a 2-day low or a multi-day low is broken out, it has to be supported with volume confirmation. If the volumes are not supporting and the price is snapping back, your point of control started building higher, it is a sign that we are going to have a trend reversal. That is a fake breakout. Maybe that is a breakout failure. All you have to do is you have to initiate long and you have to continue monitor. All I can do is that I cannot predict. What I can see is that I know that volumes are not supporting. I know that point of control started building above that. You see that point of control is 4 here, and so activity started building higher. So all I can do is initiate my trade here and continue monitor. What I don't want to do is that price coming back again and building more point of control over here, more activity. I don't want point of control to shift over here. If there is a shift, then I have to give up my trade. Maybe I am wrong in my thoughts. I have to change my opinion. Something different. What I am expected is that I am expecting market to go up, but instead market fallen down and started building activity. My point of control is building lower. Maybe I have to change my opinion over here, like a GPS. Right? Like what a GPS does, when you are using a GPS, you go in a straight path, you are right, and GPS guides you in a right path. Despite GPS guiding you in a right path, you go in a wrong direction, the GPS will reroute you to the different path, and finally it gets you to the destination. So when something is changing in the market is informing you that something what you anticipated is not happening, something different is happening. So you change your opinion because something is changing in the market. So if something has to change in the market, when I'm initiating a long trade over here, if something has to change, the change has to come in the form of a point of control. Point of control price has to come down again. It has to do more activity. TP has to widen 4 or 5 times over here. Then I'll accept that more players are interested down below the 2-day low. This is 2-day low, right? This is 2-day low here. So then I will change my opinion over here. So that is how you cannot tell whether the day is an open drive or open test drive. What you can do is that you can initiate, let's say, this particular day, when you're seeing an market opens and it started rallying, you know that market opens the gap up and it's a drive. So maybe you can only guess, maybe this day could be an open drive. That is the one maximum what you can do, right? So if this day is an open drive, all you can do is that you initiate a trade and you continue monitor. What should not happen here is that price should not come back below the previous day low, and it should not start doing this. If it started doing this, it is not a good sign of buying. It's a bad sign of the buyers are not serious. The morning buyers who showed up, they are not serious. For example, take this particular day, right? So price opens here. You see that not much of volume got traded. Means they are kind of fake ticks. Probably hardly 1 or 2 lots would have been got traded at the top. And the very next trade it had been happened over here. Traded here and price start back into it. Activity started building below. The entire day is not a good opportunity to go long at all. If you are dealing with this kind of days, unless there are something is changing in the markets, your opinion is that it's a low confidence buying. The buyers are not serious on that particular day. That's the only thing we can max to max you can anticipate from this situation, right? So this particular day, when you are seeing such kind of low confidence buying, you will be mostly aligned on the short side on this particular day. This entire day, you'll be aligned only on the short side. Maybe you know that it is a short side, but still you will be aware about this P-shape profile. So you'll be maximum targeting towards the P-shape profile. You will be limiting your targets. So when you know that how a P-shape profile, how it could take a support, that particular day as an intraday trader, you know that you have to be on the short side, but you know that price may not, the players may not give up the P-shape profile that easily. So you know what is the realistic target you can achieve on that particular day, right? Yeah, maybe I'll quickly complete this open rejection reverse. The open rejection reverse is like price opens gap down. It opens with a good confidence, but then it completely got back into the range. Point of control start building higher. Again, more activity happens. Again, more activity happens. You can see the point of control keeps on shifting and shifting and shifting there. That is good sign of a strong rejection. In a strong rejection, what happens is, in a strong rejection, price opens gap down. That is a high confidence selling at the open. But immediately what happens is it snaps back into the previous day's range and initially start by building activity here. Again, it goes back up, builds activity higher. You'll be seeing point of control initially shifted from here to here. That is a good rejection reverse, right? What is a bad rejection reverse is that price opens here, got back into the range, and it does nothing. It does balance. It's a bad rejection reverse. In such a case, you'll be seeing a stop in this band. There'll be a stop would have been formed over here. So you can consider there are two kinds of open rejection reverse. One is a weak open rejection reverse. Another one is a strong open rejection reverse. So in this case, what is happening here is a strong rejection reverse. On a strong rejection reverse, the entire value area gets filled, and you will also see point of control migrating higher on that particular day. So that will be a continuation. That will be mostly a continuation in the future. You'll be seeing a continuation in the future. But if the point of control is not migrating, there will be a stop loss formation. That stop loss are prone to revisit back. You're getting a point that there could be a formation of a stop loss. So let's take this example here again. So one of the day here, price opens here, it dropped down, but it haven't taken the P-shape profile, right? It haven't taken the P-shape profile, and the point of control also not migrated. So in that case, I will see this as a weak open rejection reverse. It's a weak ORR. Call that as a weak ORR. So of course, you'll be seeing a reference line as an ORR over here. You'll be seeing a reference line, automated reference line. It says that ORR top. So if the ORR top is coming and point of control is not shifting for the day, it is a weak ORR. Eventually, some stops would have been placed above this level. So you can expect some stop hunting to happen in a relatively short term. You can expect the short term. You can expect that to happen, right? So I can explain what happened on the 1st January activity. On the 1st January, what happened? Price plunged below this P-shape profile. That is a P-shape profile, right? Plunged below that, but that volume was it's coming with a very low volume. I'll show you in Slack how we seen that. And when the day low, 2-day low is breaking. So this is 1-day low, this is 2-day low. It broken, volumes are still not supportive. That's why I said like that day is a low confidence day. If it is a low confidence day, it gives you mean reversion opportunity, and you see where the point of control is getting built. The point of control is getting built above the 2-day low. Above the 2-day low, and there is a stop pending in this zone. So all you can do is that you can anticipate either max to max. You can anticipate price to go and clear that reference. So I'll show you how on 1st of January how we seen that day. So 1st of January. At times, ORR could be a market top. If it is confirming with the volume, it is confirming with some institutional activity. Okay, I'm in the wrong channel. This is January 4th, January 3rd. Here is January 1st. So on January 1st, it was happening here. So initially there was a so far high confidence selling. Initially the confidence was the selling was happening here, right? So but no strong commitment from the sellers in terms of volume. The volume commitment is not good. That is my observation around 927. So we are anticipating a sell-off. The sell-off was happening, but we know that the strong commitment of sellers is not happening in terms of volume. In terms of volume, because it's a holiday on a holiday season, most likely not much of institutions are likely to come. The sell-off is happening the first 1 hour, but it is happening with a very thin volume. So again, see here, it is breaking around our 1 o'clock. Right, the thing was 2-day low breakout and low volume commitment. The 2-day low has been broken out on that day. It's a low confidence selling. Whenever I'm saying low confidence selling, it's a poor way of selling in the markets. Market could snap back. Mostly they will again snap back above P-shaped profile. Again, they will snap back if there is any resistance, if there is any stop losses there, market could go and hunt it down. So it's slightly complicated, but once you get started adopting it, you will like anything. Like it's slightly complicated. Like you see that the markets are falling relatively fast. If you watch only the price, you will be seeing that 2-day low has been taken out. Oh my God, 2-day low has been taken out. If you look into the context, the volume is it's falling relatively lower. The volume is relatively thin, and price comes back. Activity was forming above 2-day low. Activity was completely forming above 2-day low. That is how a low confidence selling looks like, right? So again, it helps you to do a mean reversion trading. Here you have to position yourself in a mean reversion mode. If you position yourself in the mean reversion mode, obviously your targets are getting back above T-shaped profile and towards the ORR top. ORR top will be the one of the primary target, because it's where the stop is placed over there. There is some stops that would have been placed above ORR top. Price comes and clears those ORR top. But if it is a stronger ORR, in this case it's a stronger ORR, because the point of control initially it was here, later it was here, and later it migrated over here. We are seeing point of control shifting. You can expect that could be a short-term bottom, and market could be moving in your favor, right? So over a period of time, you need to classify which is a strong ORR and which is a weak ORR. Anyways, we'll be dealing with ORR. We have a special session on coming on how to predict the market tops and how to predict the market bottoms. ORR is one way. We will say like it's a market top or a market bottom, but not every ORR. Only if the ORR with a shifting point of control. And we have other specific features we'll be talking in the later part of the session. The other two sessions are open auction in range and open auction outside the range. So they are mostly dull and boring moments, right? So where you can see point of price opens inside the range, and most of the activity happens inside the range. The point of control never shifts outside the range. We call it as an open auction inside the range. So it's mostly a dull, boring moment. And market started balancing throughout the day, and you'll be feeling that the dull and boring momentum. But market opens inside the range, it balances inside the range. That's what open auction inside the range is all about. And OAOR is like price opens gap up, and it takes down the previous day low. It takes down the previous day low. That itself is a sign that this day could be a previous dull, boring moment, and activity still happens above previous day high. Activity still happens above previous day high. If you look from a confidence perspective, confidence will be high. But if you look from the activity perspective, activity will be still balancing. On that particular day, the first 30-minute low would have been broken down. That is a sign that the market is going to balance the rest of the day. So when this happens, by around 10 o'clock, you can say that this market is going to be a dull, boring activity. When you are able to spot an OAOR day. OAOR day in a month, you will get 1 or 2 trading days. But we don't trade OAOR days mostly. So you'll be able to say around 10 o'clock itself that this day is going to be a dull, boring day. Many times we called in Twitter, many times I called in Slack as well. And we had a very high hit rate of saying that this day is going to be a dull, boring day. But in a month, 1 or 2 days will turn out to be a wave or not much. Okay, so again, I'm going to do a quick revision of opening types, and then we are going to leave for the break. There are 5 types of opening types. Open drive, which talks about high confidence, and open test drive, again high confidence. ORR, it's a poor way of having an confidence, so we'll call that as a low confidence or an poor confidence. And open auction inside the range, it's nothing but no confidence from the buyers and sellers. Again, open auction outside the range, it's again no confidence from the buyers or sellers. And open drive, it's like price opens either with a gap up or even without a gap up. Without a gap up, it's straight away they do a march, and activity will be building above previous day high. If you measure the confidence right from the start of the day, the confidence will be high throughout the day. Confidence never changes, and all you can do is you can expect initiate a trade and wait for the price to what you should not see is that point of control will never ever shift down below the previous day high. If it is on the upside, or if it is on the downside, point of control should never get back into the range again, right? And at times it comes with a gap up, and most of the times the bottom out will be happening in the first 30 minutes. Whether it is an open drive or open test drive, bottom will be made up in the first 30 minutes itself. That kind of days you can see most of the times in the markets. In a good trending markets, open drive and open test drive are very common in a trending phases. And next comes the open test drive. The only thing with the open test drive is that it can come up with a gap up also, without a gap up also. Let's say price opens here, it took down, and all of a sudden price goes above previous day high, and it started doing more activity on the upper side, right? So you'll be seeing that confidence initially there will be a dip, but that dip will be made in the bottom will be made in the first 30 minutes. The first 30 minutes at the A period, the bottom would have been made. Rest of the day market will be trending in one direction. That's how the open test drive comes. It can come in the form of gap, without a gap also. It doesn't make any sense, but throughout the day, confidence will be higher. Throughout the day, point of control will be building above the previous day high. On the bullish case, on the bearish case, point of control will be building downside on a bearish case. So both are high confidence markets. Usually we used to evaluate the market confidence. And next comes the open rejection reverse. It's a poor way of selling. In this, we have 2 classifications. One is a strong ORR, another one is a weak ORR. If it's a weak ORR, it will act like it is a stop loss formation zone. If it is a strong ORR, then this reference will be your strong support zone. This will be your strong support zone. So what you can learn from here is that if it's a strong ORR, you'll be seeing point of control migration. Initially, point of control will be here. Again, point of control will be here. Price enters the range immediately, and point of control starts building inside the range. And at times the point of control migration happens, then it is a strong ORR. That means this will act like your support zone, right? If it's happening on the downside, this will act like a support zone. Or let's say the price opens and then it started mean reverting back, and activity is building lower. Again, price goes down, activity is building lower. Then this reference, the previous day high acts like your strong support band. So yeah, strong resistance bands in the reverse case. So that is a poor way of selling. At the opening, sellers are there, but they are not serious seller. That's why price got back into the range, and they are not serious at all, because that is one of the reasons where point of control started shifting higher and higher and higher. Okay, next comes the open auction inside the range. They are dull, boring range, and eventually it will not be supported by any volume, and activity will be happening inside the previous. Most of the activity happens inside the previous day's range, and mostly you'll be seeing point of control widening. Most of the dull, boring days, most of the days, like you'll be seeing one of the day you'll be seeing a balanced activity here. Next day also balanced activity here. Another day is also balancing activity here. All the cases value area will be overlapping. So those days those are the days in a sideways consolidation mode. Open auction in range is very relatively common in open auction out inside the range. An open auction outside the range, again, it's a dull, boring moment. It's neither the buyers are inconfident, neither the sellers are inconfident. Maybe at the open, the buyers are confident, but you might think that day could be an open drive day or open test drive day. But the first half an hour would have been broken, and then price will still trading. The point of control will be still trading above the previous day's high. That is a sign that this day could be an open auction outside the range. And probably the first half and most of the till 2:30 the market might be balancing. Maybe very rarely an open auction outside the range can turn out to be a spike day, right? So last 1 hour has to be monitored. If it's an open auction outside the range, last 1 hour has to be monitored, because maybe at times OAOR, most of the OAOR days, initially it looks like a OAOR day, but last 1 hour it could turn out to be a spike. So always open auction outside the range are dull, boring. But any excitement has to come. It can come in the last 1 hour. Right. So I guess I can stop here. If there are any questions, I can answer your questions. Otherwise, we are done with the session. In the afternoon session, we'll be talking about market confidence.
Rajendra?
Yeah.
Can a OAOR be a OD?
Can a OAOR? No, it cannot be, right? Open drive, first, the bottom out will happen in the first drive itself, in the open drive. Whereas OAOR, the first half an hour will be broken in most of the cases. So it cannot be a OAOR, cannot be OD. Open auction outside the range, first half an hour low will be broken. If it is on the, if it's happening on the upper side, if it's happening on the downside, first half an hour high will be broken. So that is the first clue that this day could turn out to be an open auction outside the range, but still point of control will be forming above or below the previous day's range. So in that case, you know that it's going to be a dull, boring auction. Most of the dull, boring auction continues till 2:30. At times till 3:30 also, but last 1 hour activity has to be monitored, because at times last minute excitement comes in the form of spike. Very rarely an open auction outside the range can turn into a last minute spike. So if OAOR is coming in, last 45 minutes, you have to be on the edge of the seat. Yeah, questions?
So Rajendra, one question here is, if there are continuous OAOR,
Yeah.
is it like an accumulation by the intraday players?
Short-term players. Because you'll be forming, it will be kind of a prominent point of control all the 4 trading days. Most likely short-term players might be controlling those days.
Okay, thank you.
Yeah.
Rajendra, I have a similar question. Like, I need a difference between the OD and the OAOR.
So OD, both the cases, it will be from a confidence perspective, right? So both are textbook style confidence, whereas let's say OD will not be dull and boring. OD will be trending day. OAOR will be dull and boring.
Okay, so let's talk about that first 30 minutes. So on the OD, it always gap ups?
Not necessarily.
Or gap down?
Not necessarily. It has to be a gap up. Textbook style talks about gap up, but in a real life market, an open drive can also happen like this. Let's say price opens here, and they took the previous day high, right? And when it takes the previous day high, that itself your confidence measurement, point of control start building above that. But the bottom out will happen in the first 30 minutes. The bottom out will happen in the first 30 minutes. It never takes at all. And there'll be a drive again. The day will not be boring. On an open drive day or open test drive day, you will never get bored. It will be excitement day. But OAOR day, even if there is a gap up or without a gap up, right? Let's say price opens here. It took the day high, but the first 30-minute low has been broken. Market might be balancing in this band, and you'll be seeing a balancing activity. Value will be developing higher. In a OAOR day, if you look into the OAOR day, value will be developing higher, but that will be mostly dull and boring. That will be mostly dull and boring. But as I said, the activity, the excitement may or may not come after 3:30, 2:30. So last 1 hour or last 45 minutes, you have to be on the edge of the seat to check if something interesting is happening or not.
Okay.
Yeah.
Yeah, Rajendra.
Yes.
How to determine it's a high volume or low volume in a live?
That we will deal in order flow section. That's a separate section which we are going to take more effort on how to determine the volume is less volume, whether the breakout is happening with a less volume or not. We need to confirm from the order flow. Or we need to know about what is relative volume. We'll be talking about relative volume in order flow charts. So I request you to go and attend the order flow sessions where we'll be talking about the relative volume and how we can determine what is the relative volume for Nifty, what is the relative volume for Bank Nifty, what is the relative volume for Reliance. That we'll be explaining so that you know that whether the breakout is happening, whether it's happening with a strong breakout or with a weaker breakout.
Okay, Rajesh.
Yeah. So, any questions? Okay, then I think we can stop the session here if there are no questions. And after session, we'll be talking more about market confidence. So I think, and after that, if any time is there, we'll talk about again more strategies which we talked about so far. On top of whatever we talked about so far, how we can build strategies, how we can interpret those information. That's what we're going to talk about it, right? So I'm going to stop the session here. And
what time we meet, Rajendra?